403B tax sheltered annuities, or TSAs. This is not the Transportation Security Administration. This is a TSA, as in a tax sheltered annuity. So tax sheltered annuities are qualified plans for public school employees and certain employees of nonprofit organizations that qualify for these types of plans. So essentially what this is, it's a qualified annuity plan, essentially. So you know how like in 401ks and other qualified plans, if you know about those, how it works is like you can put pre-tax dollars into the plan and then take that money out in retirement, and then you pay tax on it when you take it out in retirement. So the way a 403B tax sheltered annuity works is, say a teacher gets $50,000 as their salary, and they say, you know what, I want to defer $10,000 of that money of my salary to retirement. The employee or the employer, so the school, can also contribute to it as well, up to a certain maximum total contribution for the year. They can put that money into a TSA, a tax sheltered annuity, so that that teacher can set up an income stream for themselves in retirement. So they're saying, hey, you know what, take $10,000 of my salary right now, put it into the TSA so I can have it in my retirement, and then the school or the employer can contribute whatever they want into it up to whatever maximums there are for that year. So that's pretty much how it works. It's pre-tax dollars, and you pay tax on it when you take it out. The contributions are limited, and there are some catch-up provisions available, meaning a catch-up provision means that if the teacher gets past a certain age, or the nonprofit employee, once they're past a certain age, they can make additional contributions to make up any contributions that they didn't max out when they were younger. All right. Now, when you do retire and you do annuitize it, right, because you're taking all this money, you're putting it into a fund, essentially, and then it's growing, tax deferred, you don't pay any tax on its growth. And then when the person retires, they can say, you know what, I'm going to start receiving income stream payments from this annuity, so they can annuitize, is what it's called, right? So at first it's accumulating. Oh, we got Leia, our study friend here. Say hi. So say hello. She's the master of 403Bs. She's the 403B queen. So what happens is they can annuitize part or all of it. All right. So they don't have to start taking income payments from the whole thing. They can say, you know what, I'm just going to annuitize a part of it. So this is essentially an annuity where you can use pre-tax dollars to contribute to it, lowering your taxable income now and helping provide an income stream for the future. So that's the basics of a 403B. It's pretty simple. It's a qualified plan available for public school employees and certain employees of certain nonprofit organizations who qualify. Hope this helped you, and I hope this helps you pass your benefits rider, or the accelerated death benefit rider, also known as the terminal illness accelerated death benefit rider. They're all words for the same thing. What it is, it's usually a free rider that's included in the policy, meaning there's no additional cost, and it allows the insured to get a portion of, if not the whole, death benefit advanced to them if they're ever terminally ill. And terminally ill either means 12 to 24 months left to live, diagnosed by a doctor. The 12 to 24 months, it varies by each state, essentially what the definition is as terminal illness for insurance purposes in each state. So if you're selling multi-state, you want to look up to learn what that is. There are other reasons that these policies will advance the money, sometimes from company to company, and it's not just terminally ill. They can have like an extreme medical condition, maybe like an organ transplant or something like that. Sometimes maybe they can't perform their activities of daily living. Sometimes they're institutionalized. These policies will also sometimes advance money to people either in a lump sum or piecewise monthly if they're stuck in some sort of long-term care facility like a nursing home. If they are terminally ill, meaning the doctor says they have less than 12 months to live, they can get the money advanced to them. So if they have a $20,000 death benefit and the doctor says, geez, Betty, your cancer, it's going to end your life in the next 12 months. All they have to do is send that doctor's note to the insurance company. The insurance company will then advance them the $20,000 death benefit, and then they have it. And they just keep making payments on the policy until they die. And that varies company to company. Some companies make you keep paying premiums, some don't. Now, the same policy, if they're in a long-term care facility like a nursing home, then they'll get 5% of that death benefit advanced to them every month, up to 5% every month until the money's exhausted or they pass. Florida does not always allow those nursing home riders, though. So that nursing home benefit is not available in the state of Florida for whatever reason, just so that you guys know when you get into the sales thing. But the whole point of the living benefits rider, the accelerated death benefit rider, and these other riders that advance people money if they're in a nursing home, the insurance company pretty much understands that they're going to die anyway, or they're nearing the end of their life, and they don't want them to have to actually sell their life insurance policy for less than the death benefit because they need money up front. So sometimes people have done that. It's called a viatical settlement. Well, they'll sell a life insurance policy. We'll use a bigger example. Say someone has a $100,000 whole life policy. The doctor says you're going to die in the next 12 months. And they say, well, I don't know when that's going to be, but I need $70,000 now. So maybe they'll sell that policy for $70,000, transfer ownership rights to someone else, and someone else is the beneficiary. And then when they die, that person gets $100,000 and makes $30,000 off their death. The company didn't want people to have to do that. And obviously in competition from one company to another, they're trying to provide extra benefits to people. So this allows people to get that money ahead of time when they need it most, when they're terminally ill. And it can go a long way. This is a huge selling point for your clients, guys. So I recommend that when you start your insurance career and you start selling life insurance, you want to really, really hammer in on this, because most people have taken care of sick relatives before, or understand the implications of how expensive it is to take care of a terminally ill relative. So I hope you found value in this. I hope it helped you with some sales knowledge too. Premium on the policy. They can adjust the face amount of the policy up or down. Now, if they want to increase the face amount of the policy, then typically they have to go through underwriting again. That just makes sense, right? They're wanting more insurance, so they have to go through underwriting. And then typically they can change it from either term life to whole life or whole life to term life. But when you go from whole life to term life, a lot of times they do have to go through underwriting again, because whole life for that same amount of insurance is going to cost them more money every month. So if they're dropping to a term life, the insurance company is not getting as much premium every month, so it's a higher risk to them. So it means that they have to probably go through underwriting again. And also they can change the period that they will have the insurance for. So say it's a 20-year term, they can adjust it to 25 or 30, which would typically mean that they have to go through underwriting again. So it's adjustable in every sense of the word. They can adjust the premium. They can adjust the face amount. They can adjust what type of insurance it is. They can adjust the time that they have protection. But obviously, if they are adding time protection, if they are changing, if they're adding insurance, or they are getting a more risky type of insurance for the insurance company, like term life would be, then they have to go through some sort of underwriting again and prove evidence of insurability. Now, adjustable life policies can accumulate cash value, but the policy owner does have to pay above and beyond the actual cost of insurance for any cash value to accumulate. The policy owner also has the option to pay above and beyond what the base minimum premium is to pay off the policy early. So adjustable life are not super popular anymore. They've been kind of phased out. I'd really honestly be surprised if you have to know about this for your license exam. It's in some license courses, but it's so rare that, I don't remember any questions on it in my license course, but they do talk about it in some of the exam preparation material, so I wanted to bring it up to you guys here. To them, what happens when the money's paid into them, things like that. So an annuity is basically a cash accumulation vessel, and it provides income for life or for a specific number of years. Now, the purpose of an annuity is to take a large sum of money and distribute it in payments over a specific period of time or for someone's entire life. So a lot of times it's used in retirement accounts. You may take your retirement account, you put it into an annuity, and then you can get the money like for the rest of your life so you don't outlive it. Or say someone has a ton of money and they want to leave their grandchildren some money, but they don't want to leave them like a ton of money at once. They can leave the money in an annuity, and then they can have that money paid out in payments over time so that the grandkids don't just go like spend it all at once. There are many different ways. Bottom line is it's meant to take a large sum of money and spread it out in income payments over time. Now, you may wonder, hey, why would someone not just keep it in their bank account? Well, someone may not want to have access to all that money. And then also the money in an annuity can grow tax deferred. So it can grow. There's some tax benefits to an annuity. You put the money in, the interest accumulates tax deferred, so you don't pay interest on the growth every year. So annuities are marketed by life insurance companies and sold by life insurance agents. So if you're getting your life insurance license or your life and health insurance license, then you will be able to have you'll have the ability to sell annuities if you want to, and if they're offered by the carriers that you work with. So annuities are typically, from what I've seen, you mainly try to sell annuities towards someone who's like in retirement or gearing towards retirement. But what I'm going to go over here is like the basics of what you'll need to know for your life insurance license exam. Okay. Now, there are three parties involved in an annuity. There is the owner, there's the annuitant, and there's the beneficiary. The owner can be a corporation, a trust, or a person. And the owner, it can be an entity. The owner is whoever pays into the annuity and owns the annuity. right? They can make the decisions on it. The annuitant is the person who receives the income payments. Now, the income payments really depend on how long the annuitant is going to receive the payments for and how long they're expected to live. Now, also there's a beneficiary. So the beneficiary for the annuity is the person who would receive the assets of the annuity, if there's cash value or any value in the annuity left over, if the annuitant dies prematurely. Okay, so the beneficiary is one who can receive any of the money that's in there if that's an option in that annuity. It's usually easier to understand these concepts if you illustrate them. So I'm going to put an image right here that just shows how there's an owner that owns the annuity who pays into it, and then there is the annuity. The money can either start paying right away to the annuitant or it can accumulate more value and grow with interest, but eventually it does pay out to the annuitant where they receive a stream of income payments. Now, the pay-in period, the time where the owner is paying into the annuity and what they call premiums, is called the accumulation period or the pay-in period. Now, they can pay into the annuity in one lump sum, or they can pay in premiums over time, where they'll have periodic premiums. So they'll pay annually or monthly or whatever it may be. You're also going to find that some periodic payments can be flexible. So some annuities allow for the owner to pay in more money one month or more in one payment period and less money in another. So it's important for your life insurance license exam to know that in the accumulation period is when money is paid in the annuitization period, that's when money is distributed out to the annuitant. The annuitant is the person who receives the money from the annuity once it starts making income payment. There are 4 things that an annuity income amount is based on. So there's the age and gender, there's how frequent the payments are paid out, there's the interest rate, and then there is the amount of premium paid in or cash value accumulated in the annuity. If it's a lifetime income annuity, meaning they're going to receive income for life, then the person receiving the money, if they're younger, the payment's going to be smaller for the annuity because they have more time to receive that money. So say someone's 40 and the annuity's got $1 million in it and they're 40 years old, they're like, I want to start receiving this money right now. Then it's going to take longer for them to receive those payments of $1 million. So it's going to be, they have more time to spread that $1 million out. So the payment's going to be less every month than it would be if the person was 75. Right? Because the 40-year-old's going to live longer than the person who's 75. So the person who's 75, the insurance company may say, well, they're expected to live till they're like 87. So we're going to pay out that $1 million over that time period or whatever the cash accumulated is and whatever their calculations are. So bottom line, the younger someone is, for most annuities, the lower the payment's going to be, especially if it's a lifetime income annuity where they're going to get income for their life. Annuities are typically purchased for retirement funding. So like I said, say someone retires with their 401k and there's $2 million in it. They don't want to have all that money sitting there, and also they want to roll it over into something that can keep growing tax deferred. They can roll it over into an annuity, right? The money can keep growing tax deferred, and they can pay tax on the annuity payments. It can be taxed as income, but they're not going to have that big chunk of money to access, and then the money's also not going to be like subject to market volatility if they put it in a fixed annuity, which we'll get into the types of annuities in a minute here: fixed, indexed, and variable. Usually they are marketed for retirement funding. So you'll see a lot of financial advisors try to go after people who are, for clients that are nearing retirement age, because they're like, hey, this person may have some money from retirement that they want to roll into an annuity. And also too, it can be used for like college funding. So say they like put a bunch of money into an annuity and they tell the college like, hey, we're going to pay you, like parents can do this or grandparents. They put a bunch of money into an annuity and they say, hey, every month or every year, this is going to spit some money out to the college to help pay for the college. It can be used to liquidate an estate, like I said before, for inheritance. It can also be like a structured settlement or something, or like lottery winnings. You know how if someone wins a lottery, they can choose a lump sum or to receive income payments over a certain period of time. If someone chooses to receive the income payments for a certain period of time, what happens is the lottery winnings get put into an annuity, and then the income is received. The annuity pays out the lottery winnings over time through an annuity. And people hope that over time, eventually, if it's an annuity, they'll end up getting more money paid out to them than if they were just going to disperse it to themselves, and more money than that's in there. The hope is that over time they'll get more money than what's put in, right? So there are different types of annuities. They're classified one way on the premium payment method. So how is the payment paid in? Well, they can be paid in single premium or periodic premium. So single is like one payment, and then the cash can either sit there and accumulate or start paying out to the annuitant right away. An example of that is, like I said, a 401k rollover, where if someone has a 401k or their IRA when they retire, their retirement account, one single premium payment into an annuity, and then that funds the whole annuity. And then there's a periodic payment as well. So sometimes when people are younger, they will want to start putting money into an annuity for retirement early. So say someone's like 45 or 50 and they say, hey, I'm going to start putting some money into an annuity, then they can put into that in periodic payments. So that's a periodic payment type. So know that for your exam, you're going to want to know that there's two premium payment types. You're also going to want to know that there are two types of payment options. So there's going to be an immediate annuity, which the payments start within 1 year of the money going into the annuity. So say the retirement account example, right? Guy takes his 401k, he puts it right into the annuity and wants income payments within the first year. Then that's going to be an immediate annuity. That's going to be a single premium immediate annuity. Say it's a single premium deferred annuity. Then what happens with that? Same example. Say the guy retires with his 401k and he says, I want to keep the money growing for another 5 years though before I receive income payments. That would be deferred. So he's deferring the income till later. So he says, we're going to put the money in here. It's going to sit here for 5 years and grow. And then we're going to start receiving income payments from it. And then there's also fixed and variable annuities. So this is how the interest rate grows within the cash accumulation. So fixed is when the insurance carrier takes the responsibility of the investments in their general account. So the insurance company says, we are going to take all the investment risk. We're going to guarantee you a minimum level of interest. And that's what it's going to be. You're going to get a guaranteed interest, guaranteed payments. The payments are always going to be the same. You know exactly what they're going to be every time. And then there are variable annuities, which are invested directly into mutual funds and variable products, which you actually need a Series 6 and 63 to sell. You can't just go sell variable annuities with your life insurance license. So variable annuities, the money goes in, say the same example of the 401k, which this isn't good suitability, which you're going to learn about, meaning you shouldn't, like most people retiring wouldn't want to put their money in a variable product because of potential market loss. But say the guy wanted to do it, because they can do it if they want to. He takes the money in the annuity, puts the money in a variable annuity, and then that value of the money fluctuates with the stock market, essentially. Okay. The amount of money that he's going to get every month will vary based on how the stock market is performing at the time. So there are a few different ways of disposing the proceeds. There is a pure life where someone will get money for the lifetime of the annuity, and depending on what they select as a settlement option, they may have a beneficiary who receives money or may not. They may take the risk that they're going to lose the money in there if they die prematurely. Also annuity certain, which is when there's a certain period of time that the money is paid out in, where in the life refund annuity, if the annuitant dies prematurely, then their beneficiary will receive whatever difference there is in benefit between what the annuitant has received from the cash value that's been accumulated and what's in there and then what's paid out, essentially. So if there's any remaining money, and if it's a life refund annuity, then they can get some of that money back, the beneficiary can. So in a variable annuity, what happens is the owner pays in and purchases what are called annuity accumulation units. Okay, so accumulation units build up within the annuity, and then it's like buying shares in a mutual fund, kind of, right? And then when they retire, when they want the income to start paying out in the annuity, the accumulation units convert to annuity units. And then the annuity units that pay out, the amount of money that's paid out in each annuity unit is contingent upon the value of the market at that time. So the amount of annuity units is the same, but the amount of money that each annuity unit pays out depends on the how the market's performing at that time. And then there's indexed annuities. So indexed annuities are invested in indexes like the S&P 500 or something. Typically it's in the S&P 500, which is an index of equities, meaning it's an index in the stock market that shows how well the United States' economy is flourishing or functioning, pretty much. So the S&P 500 index annuities, how it works is there's typically a minimum amount of interest that the insurance company says that the account will earn, but then there's some more upside to it. So in a variable annuity, there is no minimum. So they could essentially lose money, right, if the market tanks. In a fixed annuity, there's a guaranteed interest rate, and that's what it's going to be. It's not going to go up. It's not going to go down. And in an indexed annuity, there is a floor minimum interest rate, which is typically lower than the guaranteed interest rate in a fixed annuity. But they do have a higher, so there's like a protection against loss, but typically there's a higher amount of earning potential. So example, right? say it's an indexed annuity and the insurance company says, okay, well, depending on how the S&P performs, we are going to take the first 4% interest out of it, and then you can get anything over that. So say like the market performs at 10% interest that year, the S&P 500. That means that the insurance company is going to get 4% of the interest on the annuity, and the annuity is going to receive the other 6% of that 10%. So that's how indexed annuities work. So you got to understand annuities are classified in a few different ways. They're basically just cash accumulation vehicles. They're based on when payments start. So it's either immediate, the payments start within the first year, or deferred, the payments start over 12 months or after year one. They can be classified based on how the money is paid in. So is it paid in one lump sum, or is it made in periodic payments? They can be classified on payment amounts that are paid out. So is it going to be for the person's whole life, or is there a guaranteed minimum amount that they're going to receive, or do they want it paid for a certain amount of time? It also depends on how many lives are covered. So there can be one person, or there can be a husband and wife covered, like joint or joint survivor, kind of like in life insurance. So you can have one person covered, they die, that's it. Or you can have like the husband covered, and if he dies, his wife will start receiving anything that's left over as a benefit. Or you can have it so like both people will receive the payments of the annuity. And then it's classified on the underlying investment. So is it fixed or variable, right? And it can also be an index as well. What we're going to be talking about here are authorized, unauthorized companies, and certificates of authority. In order for a company to be authorized in a state to transact business, it has to obtain a certificate of authority. And they have to obtain a certificate of authority by applying through the state's Department of Insurance. They must have enough money to do it, like enough capital and cash flow and all that stuff, surpluses, and they have to have some other things to be approved as an authorized insurer to get a certificate of authority. But once they receive it, they are technically authorized. Now, if they do not receive one, they are not authorized, and it's not okay for them to transact business in that state. So you got to be very careful when you're selling insurance to make sure you're selling a company that's authorized to sell business in that state. And if you do sell a policy and it's not authorized, and that company's not authorized in that state, you may be liable to pay claims. You could lose your license and a bunch of other stuff. So definitely want to be careful with that. There are some penalties to the agent. Long-term care riders. So a lot of the riders that help with long-term care do cost additional premium. However, there are some that don't. Now, what these riders do is they allow the insured to receive some of the death benefit in advance before they pass away if they are ever in a long-term care situation, like nursing home, skilled nursing care, something like that. Typically, there is a certain period that they have to be in the nursing home for before this benefit will kick in. So it's not like, hey, you're in a nursing home today, cool, we're going to start this benefit tomorrow. It's usually like you have to be confined there for anywhere from 30, 60, or 90 days. And then the doctor has to say, yeah, they're permanently going to be here before these riders will kick in. Sometimes they'll actually waive the premium. Okay, so there can be a nursing home waiver of premium, where if they're in a nursing home, the premium gets waived, just as in like a disability waiver of premium rider. What happens is they're in a nursing home for a certain amount of time. They make those payments while they're in the nursing home. Once that qualification threshold passes, where, hey, once you've been here 90 days, then we're going to start covering your payments, it will refund the premiums paid and then cover the premiums moving forward for the nursing home waiver of premium. Now, there's a long-term care rider which will advance some of the death benefit if the insured is in a nursing home. Sometimes these cost money, sometimes they don't. The long-term care rider that will advance some of the death benefit, how that works, they have to be in the nursing home for a certain amount of time before it kicks in, and then they will be advanced some of the money either in a lump sum, which some policies have, or in a monthly income check. So some policies say, well, we're going to advance you 50 to 100%, whatever they want, of the death benefit if you're in a nursing home permanently. Or they can say, we're going to give you like 5% of the death benefit every month until it's exhausted, or you want to stop the payments. With any of these riders where the death benefit is accelerated to the client ahead of time, the remaining death benefit, once the insured passes away, is essentially the original face amount minus any outstanding loans or minus any money that was taken out of the policy for the advancement of the death benefit, minus any interest either from a loan or from what the company would have lost by advancing that death benefit. So what I mean by that is we'll just use the death benefit interest as an example, or the accelerated death benefit interest as an example. So say they have a $100,000 policy and they end up getting advanced $50,000 because they're terminally ill or in a long-term care situation, and they elect to get that money ahead of time. Well, the company is also losing out on the interest that money would have earned. okay? Because life insurance companies make their money by taking the premiums and then investing them and earning interest on their investments, right? The company, obviously, if they advance you 50,000 of that 100,000, then they're losing interest on that 50 grand while they gave it to you while you're still alive. So they want some of that interest back. So every company's got a different policy and how much they take back. Usually they want all of it that they would have lost back. Buy-sell funding. Buy-sell funding is a concept in life insurance where a company has a continuation of a business if someone who owns the business or is involved in the business dies. Okay, so imagine I go into a partnership with you. You decide one day that you're just going to go dying on me. And what happens is I want to buy out your piece of the business. So say the business is worth $1 million. We are each invested $500,000 into the business, right? If we split it, each of our stake of the business is $500,000. So I want to buy out your stake when you die. Now, a lot of this is for buy-sell agreements, is what it's called, buy-sell funding. So that, like, if say you pass away and your family, instead of your family inheriting the business and kind of running it and not knowing what they're doing, there's an agreement where if you die, I get the life insurance benefit and I can buy out the piece from you, from the family or whatever, where I would then have full ownership of the business. So buy-sell agreements and buy-sell funding, they are based on continuation of a business when a key partner or a shareholder or when an employee in the company dies. So there's a few examples I'm going to go over here. Cross purchase. So cross purchase is when partners in a partnership get a policy on each other. So say there's partners in a partnership, you get two people, and then they each get a policy on each other. Okay, that's a cross purchase. Then there's an entity purchase. An entity purchase is when the partnership buys a policy on the partner. So in the actual entity, the company buys a partnership on the partners. In any of these business policies as well, the business is, if it's an entity purchase, the business is the owner, the applicant, the beneficiary, and the payer. Next is a stock purchase. So it's in a private corporation when each stockholder buys a policy on others. So it's like when each stockholder in the company buys a policy on the other people in the company. Okay. And then there's stock redemption. So it's when the company buys a policy on each stockholder. So as you can see in buy-sell funding, it's either the people who own the company buy policies on each other, or it's the company buying a policy on the people. So that's the basics of a buy-sell agreement. What you really want to know is that they are designed for business continuation, so that if an owner of a business dies, then their stake can be paid for by the remaining business owners. So churning is, in life insurance sales, is when you keep reselling someone a policy in order to keep getting first-year commissions on that policy. So, for instance, let's say you sell someone a policy, you're going to get advanced commissions. So, in life insurance, your first-year commissions are typically bigger than any other commissions that you get. You sell them the policy and you're going to get your first-year commissions on that policy. Usually, the company gives you a chunk of your first-year commissions up front. It's called an advance. Once you get your advance, then it pays out through the rest of the year. And the first year, you may get a huge chunk of money. And then the next year is for your renewals. If you receive renewals, you'll get a smaller piece. Churning is if, say, that person gets their policy and then you get the advance commission and they pay for a little while and then you have them cancel and get another policy so you can get new first-year commissions on that policy. That's an example of churning. So it's like, you're just churning business. You're passing business around. Imagine churning butter. So you get a deal and you're just mixing it up with a bunch of different policies so that you can keep churning it. And every time you churn it around, you get money that comes out. Cha-churn, cha-churn, cha-churn. So you want to make sure that you don't do that, because it's definitely illegal. It can result in you getting your license revoked, and you don't want that. You want to get your license and keep it, because this is an amazing career. Coercion is when you force someone to buy a policy through mental or physical force or threats. Like, you could threaten that you're going to hurt someone if they don't buy a policy, or you can threaten that you're going to like start a bad rumor about this person if they don't buy insurance or something like that. Another form of coercion could be done, like sometimes when people get loans through a bank, they have to get life insurance. If the bank says that they have to get the insurance through a certain insurance carrier, then that could be a form of coercion as well. So essentially, all you got to know is that coercion is when someone is forced to get insurance through physical or mental force, and they're kind of coerced into doing something against their own will. All right, we're going to talk about 3 more policy provisions in this video. We're going to talk about consideration. We're going to talk about ownership rights and the owner's rights of the policy, the owner of the policy's rights, and we're going to talk about assignments. So consideration in the policy provisions is really like, what is each side putting up? So what are they offering? The insured, the person whose life is being insured, they are offering in the consideration a promise that they will pay the premium every month or every year or whatever the premium payment mode is, how frequently they pay it. And also that everything they said in the application is truthful and that everything was done, it was true and correct to the best of their knowledge and belief. Okay, so those are the two things in the consideration for the insured. And for the insurer, the insurance carrier, in the consideration, it's their promise to pay the claim if the insured dies. Next, we move on to ownership rights and owner's rights. Now, there's really four parties in the purchase of a life insurance policy. So there's the insurer, which is the insurance company. There's the policy owner. There's the insured. And there's the beneficiary. Now, a lot of times the insured and the policy owner are the same two people. Also, sometimes there's a payor. So sometimes there's someone separate who pays the policy. But for your licensing exam, all you really got to know is that there's an insurance company, there's the person who's insured, there's the person who owns the policy, and then there's a beneficiary, the person who gets the money when the insured dies, okay? The only one who can really make changes to the policy is the policy owner. So the policy owner has exclusive rights to that policy, meaning they can change the beneficiary. They can receive living benefits like the terminal illness benefit in the policy where the money can be advanced to the owner if the insured is terminally ill. They have access to cash value. They can select the benefit payout option, meaning do they want it to be lump sum or do they want it to be paid in overtime, where the beneficiary gets payment installments. A lot of times they pay the policy premiums, and the policy owner has to have insurable interest in the person who the insurance is on when that person applies for insurance. So it really just means that the person who's taking out the insurance on the insured has to have some vested interest in that person dying. Like they're going to sustain a loss if that person dies. So obviously, if the person getting the insurance is the owner and the insured, right? If the insured and the owner are the same person, like I'm taking out insurance on myself, then obviously I have insurable interest on myself. So what that means is like, I can't just go get life insurance on Jeff Bezos because he's rich. I can't just do that. I could get life insurance on Jeff Bezos if I was on the board of Amazon, because if he dies, then I want to make sure that he can be replaced. His human life value can be replaced, but you can't just go get life insurance on anybody. So they pay the policy premiums. If the insured is not the policy owner, if someone else owned the policy, that's called third party ownership. So a lot of times that happens, like if a parent gets a policy on a child, the parent owned the policy, the child is the insured, it's third party ownership because someone other than the insured is owning the policy. Now there is assignment of rights. So an assignment of ownership. The owner of the insurance policy can transfer ownership assignment. They can transfer assignment of ownership to someone else. Now they can do this completely, and that's like complete full transfer. That's an absolute assignment. Okay. And it has to be done in writing. Say I own a policy on my son. If I had a child, I could transfer the ownership to his mother, and it would not change the fact that he is insured. It just changes the owner of the policy. So at that point, I would no longer have access to the cash value. I couldn't change the beneficiary. She could. Okay, so you can transfer ownership in an absolute way when you transfer all rights of the policy. Now, there's an assignment provision of a policy that explains all this stuff. And you can also do collateral assignment. So collateral assignment involves partial transfer of rights. So this can usually be done to secure a loan or a transaction. So for example, say I have $1 million life insurance policy out on myself. Okay, I want to transfer ownership, partial ownership to the bank so that they can know that they're going to be the beneficiary of that money. If I die, then I can do that to secure a loan. Right? So say I get a big life insurance policy and I want to get a loan out. A lot of banks will require this if you take very, very large loans for you to get a life insurance policy. That way, if you die, they can have the money to satisfy what's remaining in the loan. It's only partial assignment. Collateral assignment. It's only a partial transfer of rights. Remember, it's called collateral assignment because the insurance policy is at like collateral for the loan in the event of your death. Once the debt or loan is repaid, the assigned rights are returned to the policy owner. So it's like a policy. You can partially transfer rights to someone under contingency that once that loan is paid, then the rights come back. Controlled business is when you're essentially writing business to your family or close friends or business associates. Now, insurance companies obviously don't like this because it can bypass adverse selection, which means that you could potentially figure out a way to get people approved for a policy that they may not actually qualify for because of knowing the ins and outs of the insurance carrier that you're appointed with. And also, the insurance carriers are scared that what you're going to do is you're going to go and get commissions on a sale. and then have that person that you wrote actually cancel their policy. You're going to get the sale, you're going to get advanced commissions on that deal, and then they're scared you're just going to go have them cancel the policy and not pay back any chargebacks or owed commissions. So states are really, really strict about this. Carriers can be really strict about this, and they try to shy away from controlled business. Actually, in most states, you can't get your license if your only intention is to write a policy on yourself or family members or friends or really close friends or close business associates. It doesn't say friends in the definition, but I would consider writing like someone who's like my best friend. I would consider writing them a policy controlled business. So I hope this helps you pass your life insurance pre-licensing exam. There are some exclusions in life insurance policies that you'll need to know about to pass your life insurance exam course. So there's some risks that the company won't cover. For instance, aviation is one. These are exclusions. So they say, hey, if you are on an airplane that's piloted by someone who's not a professional airliner pilot, like a commercial airline pilot, and you die, we may not cover that death benefit. If you have a hazardous job, like if you train skydiving, or you like to skydive frequently, or you're a mountain climber, or you like to swim with sharks or something like that, like they may not cover the death benefit if you die in that type of situation, or you'll have to pay a higher premium if you have a risky job. Now, there are also war or military exclusions. What these usually is, sometimes insurance companies will exclude deaths of active duty military or if someone dies in an act of war, but that's not common anymore. Usually they're included, or they may not insure someone at all. The insurance company can make that distinction if they're going to insure someone who's in the military or who's going to war. And then also suicide. So there's a clause to protect against the company against suicide. So if someone buys a policy and they commit suicide within the first 2 years of that policy being enforced, the death benefit will not pay out. If 2 years pass and then they commit suicide, then the death benefit will pay out. So I covered some things there that are exclusions. Not all these are included in every policy, but these are just some examples. So there are some that are standard, which is like usually aviation and hazardous jobs. And then sometimes there's things about war or military in there. And then suicide, there is a suicide clause in there as well. We're going to go over what an insurer is right now, the basic definition of it. Usually an insurance company, sometimes it's not necessarily an insurance company. They can be fraternal benefit societies and other things, but it's the principal organization or corporation that is insuring the loss, all right? And they can be classified in a variety of ways. They can be classified based on ownership. Are they owned by stockholders? Are they owned by policyholders? They can be classified based on authority to do business. So where are they allowed to do business? They can be classified based on location, based on where they're domiciled. They can be classed on their marketing and their financial rating. These can all kind of go together, and they can kind of be combined in different classifications. We're going to cover delivering the policy. Okay, this is an important step in the life insurance application and approval process. Now, delivering the policy is when either the insurance agent brings the policy to the client, which is the most recommended version of the policy delivery, or when the insurance carrier mails a copy of the policy to the client. Okay, so it can work either way. Either the agent can bring the policy or the insurance company can mail it to them. Definitely recommended that the agent brings the policy to the client. Once the insurance it's considered delivered when the agent brings the policy to the client's house and gets a delivery receipt, essentially the client signing a piece of paper saying, yes, I got this policy. And it's also considered delivered when they actually mail out the policy. Delivering the policy is a great opportunity for the insurance agent to review the details of the program, go over any provisions that they qualified for, go over any changes that may have been made to the policy in the rating process, and go over any details of the policy that may be active at that time, any provisions or features that may be active for that client at that moment. It's also a great time for the agent to go over anything different about the policy they were approved for than may have been on the policy that they initially applied for. Okay, this is a great time as well to review the details of the death benefit, if there's any cash value, any riders that are on there, when riders expire, things like that. Insurance companies and the agents must provide a life insurance buyer's guide to the client upon delivery of the policy, to the insured upon delivery of the policy. What this is, it has language that's approved by the Department of Insurance and simply explains that they should shop around for different amounts of coverage. They should shop around different companies to get the best rate. It explains how to kind of come to a decision of how much insurance that they should apply for. All policies and applications should actually have a buyer's guide delivered to the client before taking the first payment on the application unless there is a free look period on the policy. A free look period is when the insurance carrier gives at least 10 days to have a unconditional refund period. Now, a free look period means that if say I apply for the policy, I submit my first payment, and I decide within minimum of 10 days of the policy being delivered that I don't want it anymore, I can get a refund of my first payment. Every company has a little bit different of a rule or regulation on what their free look period is, how long it's going to be. If there is a free look period, then the buyer's guide can be delivered with the final policy. If there's no free look period, the buyer's guide has to be given before the initial premium is taken. But I've yet to see an insurance company that doesn't have a free look period. There is a policy summary that comes with any policy. And what that does, it gives the name and address of the insurance company. It gives the name and address of the person applying for the insurance. It gives the name and address of the agent. And it gives the names of the type of policy and the names of the riders. And sometimes it includes a brief description. It also usually gives a year-by-year breakdown of the death benefit that's available each year, what their premium will be, and if there's any cash value available, and what a surrender value would be in the policy as well. This must be provided with each application delivery. So it's important to know that a policy summary is very specific information about the exact policy, and a life insurance buyer's guide is just very general information about life insurance itself. There can also be an illustration included. Now, an illustration is a depiction or a presentation that shows some non-guaranteed elements of a life insurance policy over time. For instance, some companies may say their cash value grows faster than other companies for their whole life policies. There's going to be a guaranteed cash value section and then a non-guaranteed cash value section that's based on dividends that the company earns. So there are a few different elements of an illustration that have to be included. The illustrations are also given usually in the presentation of the policy when someone's trying to sell a policy as an agent, saying, hey, this is why you should buy it because it has all these cool things in it. There are 3 things you have to do. You have to distinguish between guaranteed values and projected non-guaranteed values in the illustration. You have to tell them that the illustration is not included as part of the policy contract, and you have to identify that certain values that are not guaranteed are not guaranteed. You actually have to let them know, hey, these values are not guaranteed. The agent can only use illustrations approved by their insurance company. So usually you can run an illustration once you get your license and you get appointed with different insurance companies, or one insurance company. That insurance company will usually have a software tool so that you can run an illustration. What you would do, you'd put like someone's age, how much insurance they're applying for, what type of a policy it will be, things like that, and then it will run illustration and generate a document that'll show you the values year to year for that policy. It may have how much they spend on it, it may have cash value, it may have other values there, but you do have to explain that the non-guaranteed elements are non-guaranteed. So when does the coverage begin? Okay, so coverage begins when, well, there's really 2 circumstances. One is when the client does not make a payment with the application. Okay, when the client does not make their initial premium payment with the application, coverage starts when the agent collects the initial premium. And they usually have to do that on the policy delivery if they didn't collect it when the insured applied for the policy. Now, the agent may be required to obtain a statement of good health from the proposed insured, or the insured in this point, that they have to sign and just say, hey, nothing has changed in my health since I applied for this policy. Okay, it's just like a document stating that, yep, I applied a little bit ago, nothing's changed, and I accept this policy as is. If the policy first premium was submitted with the application, so if the initial premium payment was submitted with the application, the policy would start on the day that the payment is made if there's no medical exam. And if there was a medical exam, then the policy would start on the day of the medical exam. The most important thing for you to know from this is that if they do not submit a payment, they do not have insurance. The Disability Waiver of Premium Rider. Now, what the Disability Waiver of Premium Rider does, and what you'll have to know to pass your life insurance licensing exam course, is that if the primary insured is totally disabled for 6 months or longer, then the insurance company will waive the premiums. Now, this is a rider added to a policy, just like a tie is added as an accessory to a suit. So if someone gets this on their policy, they have to pay extra every month for this. And it means if they are totally disabled, that the insurance company will start to pay their premiums. But however, they have to be disabled for at least 6 months. They have to pay those premiums for those first 6 months that they're disabled. After 6 months, if they're still permanently or totally disabled, then they can enact this rider, and the insurance company will refund the previous 6 months payments. They'll waive the future premiums until the insured is no longer totally disabled. Now, in the first 2 years of this rider, it means, are you totally disabled from doing your job? Okay. Can you not do your job, your normal job? After 2 years, it's, are you totally disabled from pretty much doing any job at all? So it's working based on your previous training, education, and experience. So they could justify and say, well, you can do basic math. So you can sit there and punch on a cash register, right? So they're pretty much saying, like, after 2 years, it's really hard to keep this going to prove that you're totally disabled from any position that you have. Now, every insurance company has some slightly different definitions on this, but that's in general how it is. And once the insured is no longer permanently disabled, they have to keep making their premium payments, and they have to consistently show that they are totally disabled. Next, we have accumulation at interest. So accumulation at interest means that the insurance carrier actually keeps the dividend in an account where it grows. So the insured or the policy owner is saying, you know what, just keep my dividend, put it in a separate account, let it grow in interest, and I'll be able to access it whenever I want. So the $100 goes into an account where it earns interest. Now, the interest on the dividend is taxable, but not the dividend itself. Okay, if that $100 earns $10 in interest, the $10 is subject to tax. End up being maybe like $6, $7, or $8, depending on how much money the person actually made that they'd get from that. Paid up additions. So paid up additions is another dividend option. So take two words here, the paid up part and the addition. So the paid up means that the dividend is used to purchase a single premium policy that adds to the face amount. So essentially, with life insurance policies, you can get a paid up policy. So they have single premium policies, they have 5 premium policies, 10 premium policies. Essentially what it means is you're saying, take my $100 dividend and give me a permanent life insurance policy based on whatever that $100 will buy. So it's a fully paid up life insurance policy. They never have to make another premium on that policy. Now that's the paid up part. Okay, so the dividend, the $100 is used to purchase single premium policy that adds to the face amount. The $100 premium buys a single premium whole life, and it creates a small increase in the death benefit. So say they had a $50,000 whole life policy, and that $100 premium bought a $120 paid up face amount whole life policy, then that new $120 paid up policy would be added to the $50,000 original policy. So the death benefit would now be $50,120. Okay, that's the new face amount of that whole policy altogether. So it creates a small increase in the death benefit, all right? And that additional $100 policy accumulates cash value too and earns dividends. So now you have the big hunker junker policy earning dividends, and then you have the small one earning dividends and cash value as well. Okay, so they start working together and it all starts to compound. And this is when you see life insurance policies really start to take off. And interest accumulation is when they use paid up additions. So if you see people who are like, a whole life policy so I can earn a ton of money on my cash value, this is when they are talking about getting a policy through a participating company that earns dividends and using paid up additions, right? Because that $50,120 policy is now going to earn a larger dividend next year than just the $50,000 policy would. And then that new dividend is going to go to buy another paid up policy that's going to add onto it, and it just keeps stacking and compounding over time. So the graph is going to steadily increase over time. So that just keeps growing and growing and growing. And this is the default option if no other dividend option is chosen. Next, there's the paid up option. So paid up option, the dividends accumulated end up paying up the policy early, so no more premiums are needed. So essentially that $100 keeps growing in interest and earning other dividends, and eventually goes to pay the policy up. So they say, okay, we're going to wait till there's enough money earned from the dividends and their interest to just pay the policy up, and then no one has to make any premium payments anymore. So that's the paid up option. Essentially, it's almost like a larger reduction of premium, where essentially there's just so much in there that no one has to make any payments anymore. And then next we have the 1-year term policy. This is the last dividend option, where dividends purchase a 1-year term policy that actually increases the death benefit. It's either a 1-year term policy for whatever death benefit it can afford, or a term policy in the amount of cash value in the policy for as long as it will buy it for. So example, we have the $100 dividend, right? That may buy a $700 1-year term policy, for example. This is just an example. It's the actual amount of insurance it's going to buy is dependent on the age of the insured when they get that 1-year term. Or say there's $1,000 in cash value, term on $1,000 cash value for 9 months or whatever it would buy it for. Okay, so those are the two ways that the 1-year term option can work. It can either say, okay, I got a $100 dividend here. How much term insurance will this buy if it's a year term, right? And the amount that it will purchase depends on how old the client is when they get it. Or they're going to say, you know what, how long will this $100 dividend get me a 1-year term policy equal to the amount of cash value that's in there? So those are dividend and dividend options. I hope that helped you guys. I hope these explanations here help. Sometimes like, oh, insurance coverage offered to you by this company. But in the legal aspect of it, the way it works is the person getting insurance, or the person whose life is being insured, is the one presenting the offer to the insurance company in the application, saying, I'm offering to be a client of yours, right? And then the insurance company decides to accept that offer or not. Number 2, we have a consideration. Consideration is the value being offered by both parties. So the value being offered on part of the insurance carrier and the value being offered on part of the insured, the person whose life is being insured. The value being offered on part of the person whose life is being insured is the monthly premium and the information in the application, right? So monthly premium is how much they're paying every month for the insurance, or annual premium or whatever. The premium is how much they're paying. That's what their consideration is. The consideration on part of the company is, hey, we're going to pay this claim if you die. Number 3, we have competent parties. So everybody involved has to be of legal age. They have to be able to make decisions on their own. So they have to be like mentally competent to be able to make those decisions. And they also have to not be on drugs. So if someone's under the influence of like narcotics or like some sort of alcohol or something like that, if someone's on drugs, then the contract can be voided. That's what competent parties mean. And then the last one is legal purpose. So legal purpose means that there has to be insurable interest. This means that there's got to be a real reason why the person is applying for insurance, or why that person is getting insurance on their life. What I mean by this is there has to be a loss suffered by someone or something. Say your neighbor's like super loaded, you can't just go get insurance on your neighbor if you don't sustain any loss when that person dies, right? A husband or a wife can get life insurance for themselves and leave it to their family, because if they die, they have to continue the income and they have other debts and obligations to their family. So there's a loss that takes place. So there's insurable interest. And the reason why this is in place is so people can't just profit off of the death of others. So that's kind of it's kind of messed up. So those are the 4 elements there. We have agreement, which is the offer on part of the insured and the acceptance on part of the insurance carrier. We have the consideration, which is the value being offered by both parties in the contract. So the value being offered by the insurance carrier is, hey, we are going to pay the claim if you die. The value being offered by the insured is the information in the application and the monthly premium, or the premium. I keep saying monthly, but just because most people pay them monthly. And then the competent parties, it means everyone involved has to be of legal age, not on drugs, and mentally able to make a decision for themselves. And then the last is legal purpose. There has to be a reason, a legal purpose for someone to get insurance. There has to be a loss suffered when the insured dies in order for them to get life insurance. And they have to give consent as well. So consent has to be given. Like, you can't just go get life insurance on someone without them knowing, without anybody like knowing and being involved in that. The entire contract in an insurance policy includes the policy itself, a copy of the application, and any riders and amendments or endorsements. So it's the actual policy that says, hey, like this is what you have, and then the application that was submitted to the carrier. So that's included in the final policy as well. Also any riders. So a rider is something that's added to a policy. So say you get like a whole life policy. Whole life policies have the option to add a term to it, almost like a little bonus, an accessory, right? You can add that. Some have riders where they'll help cover like nursing homes. If you go to a nursing home, you can take some of the death benefit to help cover that. They'll advance it to you ahead of time. It's like an attachment to a policy, and an amendment or an endorsement could be a change that's needed, or some sort of authorization that's needed on the policy after it's applied for. For instance, say you apply for like one rate and then you get rated down to another rate, then you have to have an amendment or an endorsement to make that change and authorize that change on that policy. So that's all included as a part of the standard policy provisions per se. There's no like nationally adopted like rule like you have to have all these, but this is just the standard that's followed. These are a few of the things. Now, the next one is the insuring clause. It gives a basic agreement between the insurance company and the person who is buying the insurance, the insured. And it just says that the insurance company will pay the claim if the insured dies, as long as they've made their premium payment. So this is usually on the front face page of the policy when it comes in the mail or when it's delivered. The insuring clause, it says the premium, how much the insured has to pay, the death benefit, it has the duration of the policy policy and like what type of policy it is, if it's a whole life or a term policy or anything like that. And then it also says the parties of the contract. So maybe the beneficiaries, the insured, the owner, if it's different from the insured, the insurance carrier. Now we also have a free look period. So a free look period gives the insured a free look at their policy. It's like a refund period, right? It's like a refund policy essentially. So it's like you buy a shirt and you get, 15 days to return it with the receipt for your cash back. And after that, you're stuck with it. So with the insurance policy in the state of Florida, it's a 14-day law. So they have 14 days to look at it once they receive the policy, not when it's issued. Okay. So the insurance company may issue the policy, then it takes a few days to get to the insured, and the insured gets it. At that point in the state of Florida, they have 14 days to review it. Now, every state's different. Some go to 10 days, some all the way up to 30 days. And none of those things can be changed once the policy's in effect without both parties agreeing to the change. So none of the things in the entire contract can be changed once it's solidified and set in stone. So false advertisement is essentially when you advertise any false, misleading, deceptive material or lies, essentially when you advertise false things. It's pretty straightforward, but it's essentially like, say you make an ad and you lie about the product. Say you say, since this life insurance policy is with a mutual company and participates in dividends, then it is actually stock in the company and you're getting a share of the company. That's false advertisement because it's not a share in the company and it's not stock. So you just can't advertise false things or things that lie. Fiduciary responsibility is when a client gives you money and they trust you with it. So the definition is someone with power or property entrusted to them to give for the benefit of someone else. If your client gives you their premiums, you have a fiduciary responsibility to not do anything bad with the money that they give you, right? You can't go like put it in your bank account and then use it for something else that you want. You have to use it for what the client wants you to use it for. So that's having a fiduciary responsibility. It's also illegal actually for you to commingle the funds. So if your client gives you like $100 for a premium, you can't go like buy Chinese food with that and be like, yeah, I'm going to use that money right now to go out to eat. Next week, I'm going to use $100 out of my paycheck to pay the premium. Can't do that. That's what fiduciary responsibility means, or fiduciary capacity. I'm going to be going over what a domestic, foreign, and alien insurers are, what those definitions are. Regardless of where it's incorporated, an insurance company needs to be certified in the state that it wants to do business in before it's allowed to actually transact business there. Domicile means the location of where the company was incorporated. So domiciling is like it is domiciled in this state, or domiciled, however you want to pronounce it. But it's domiciled in this state or domiciled in this country. So there are a few different words that we use. You're going to find on your exam course that have to do with these. The first one we're going to go over is domestic. Okay. Domestic means it's incorporated in that state. So like if I said a Florida domestic company was incorporated in Florida. So if we're in Florida, if I'm selling a life insurance carrier that is domiciled in Florida, I would say it's a domestic company. Next is foreign. So foreign is where it's incorporated in another state, Washington, D.C., or a territory. I mean, incorporated means like that's where it's created, all the articles of incorporation, where the business essentially was like started, okay? So a foreign company selling in Florida would be a company incorporated in another state. Like if I'm selling a foreign insurance carrier here, then it could have a certificate of authority to practice business here and to sell insurance here, to insure people here, but it may be incorporated in like, Kansas or something like that, or Texas, in which case that would be a foreign company, a foreign insurer. And then an alien insurer means it's incorporated outside the United States, showing that you have coverage. It's just a little certificate. Now, the main master policy is given to the employer or the sponsor. In underwriting for this, to determine what the rates are that will have to be paid. Now, in that situation, the company is paying for the whole thing. There are some where you will pay part of it too, and the company will pay for some of it. Someone is paying for it at the end of the day, bottom line. Even if you aren't, your employer pays for it. And they think they get to like write that piece off. So it's like a tax incentive for them. Based on the group characteristics and makeup determines the price that the employer has to pay per person. So at first, it's based on the purpose or the nature of the group. So like, what is this group for? Like, what do they do? If they're like a massive group of rock climbers, then it's probably going to cost a little bit more money than if they're just like working in a factory folding boxes. So what's the purpose or the nature of the group? And once again, you can't just form a group just for the sole purpose of getting life insurance. That can't be like the reason why the group was formed. Next is based on the size. So the larger the group, the more accurate the actuarial predictions will be and the less risk the company actually takes. Another thing it's based on is turnover. So these insurers expect steady turnover in a company where the older people are leaving leaving and then younger people are coming in. Okay, it can't be like no younger people coming in and everybody just getting older in the group. If there's a good turnover rate, then that's going to lower the premium as well. That'll help determine and influence the premium. Then financial strength. It's based on the financial strength. Like, hey, can the company pay? Or can the group pay? Does the company have the money to actually pay these premiums? What's their income look like? Gender, too. What's the ratio of men to women? So like, it's not always like, well, there's this many women and this many men, and the men and women pay the same premium. What's the ratio of men to women? It's balanced out. And then the age. It's based on the average age. So it's just kind of like based on averages of the group and the group as a whole, rather than one individual person's flaws or risks actuarially. Actuarially means pertaining to the underwriting that they use to figure out, hey, how long is someone going to live? There's also a minimum amount of people that are required to participate in. Now, there are conversion privileges too. So say you had this $20,000 policy and you leave. Now, you can actually convert that policy into a permanent, a whole life policy or anything except a term policy for that same $20,000 face amount. So you have a $20,000 face amount to your employer, you leave, you get to keep it when you leave, but your premium is going to be based on your gender and how old you are. And it's also going to be based on what type of policy you're purchasing. So whole life or universal life, typically. You now have to pay that premium. And in most cases, and everyone pays a standard rate. So in most cases, it doesn't make sense to convert that policy because it's usually going to be really expensive. And the only time it would make sense is if someone left the company and they were like super sick, deathly ill, because they could probably get a cheaper policy somewhere else. Bottom line, they usually make the rates so that people wouldn't want to buy the policy when they leave because they're no longer part of the group. And the company says, hey, you're more of a risk to us now that you're not part of this group, so we don't want to take that risk anymore. You'll still be able to convert it, but you're going to pay a price for that. So if someone's healthier and younger, it usually doesn't make sense for them to convert that policy. I've run into some situations where I've seen people convert their group life insurance policy to an individual personal policy because it made sense because they were unhealthy and they had some really bad health issues, but usually that doesn't make sense. People usually can convert this policy within 31 days of leaving the group. And if that master policy that the employer owns over the group is canceled, then people in that group who have had the policy for 5 years or more are able to convert it to a permanent policy without providing any evidence of insurability. So that's kind of how it works when you leave. Other than that, you lose it. Most people just don't decide not to convert it. Now, there's two types of plans based on payment. So contributory versus non-contributory. So non-contributory plan is when 100% of the eligible employees are in it, and it's when the employer pays the whole thing. So non-contributory means non-contributory for the employee. So the employee does not have to pay anything. So for that $20,000 plan, it would be a non-contributory plan for me because I don't actually have to pay into it. I just start working there, I sign something, say, hey, who's going to get the money when I die, and then that's it. But a contributory plan is usually when I want to add some extra. Okay, so if I wanted to add some extra, then the employer would either I cover it or the employee and I share it. That's in 75% of eligible employees must participate in that for it to be active. In the non-contributory, every eligible employee, 100% of eligible employees have to be in it with the employer. So if it's a non-contributory, the employer has to pay for it for everyone no matter what. In a contributory, only 75% of eligible employees have to actually be entered into it. That's the basis of group life insurance. It's usually annually renewable term. There are some companies that do group whole life, but it's very rare. It's usually annually renewable term, which means it's the cheapest form of purest form of life insurance you can get. It's a super cheap term policy for that single year, and that's it. The guaranteed insurability rider allows a client to add coverage to their policy at specified intervals or events without them having to prove evidence of insurability. So without them having to go through underwriting again. This usually expires at age 40, although every company can have a different policy on this. So what this means, if you have a guaranteed insurability rider on your policy, say you have a guaranteed insurability rider to add coverage to your policy every 3 years. So say you have like $1 million term policy, you may have a guaranteed insurability rider to be able to add $5,000 or $50,000 of coverage to your policy every 3 years. Or say you have a whole life policy. It's common on whole life policies. Like every 3 to 5 years, you can add an extra 50,000 or 20,000 or whatever. It would be specified within the policy how much you can add. So you have the option to buy more insurance at different intervals in time without having to go through underwriting again. So if you get your initial policy, you go through the whole underwriting process and you get approved for it, great. If you get approved with the guaranteed insurability rider, it means that at certain intervals of time, you'll be able to add more insurance with just an increase of premiums. you have to pay more money, but you don't have to go through underwriting again, no new blood tests, doctor's visits, or anything like that. There's also guaranteed insurability riders that allow you to add coverage, say if you have a child or you get married or like things like that, like certain life events. All right. And this rider also stacks with other riders. So what that means is we talked about the waiver of premium rider, the disability waiver of premium rider before. Now, what that means is that if you're disabled, after a certain amount of time of being disabled, the company will pay for your premiums, or they'll waive your premiums, right? So you don't have to make payments anymore on your policy. Now, you can also use the guaranteed insurability rider to increase your coverage, which would technically increase your premium. But since if you're disabled, you fall under the waiver of premium rider, means you can still increase your coverage without having to pay that additional premium. So the premiums would still be waived.
Okay, we're going to be covering HR10 Keogh plans. So Keogh plans were actually formulated by a guy named Eugene Keogh. I think that was his name, Eugene Keogh. Keogh plan it's a retirement plan for self-employed people. So you either are self-employed or you are working part-time or full-time as a partner in a business where you own at least 10% of it. So this was designed for people who are self-employed to be able to have some sort of retirement plan. Now, contributions are tax deductible, so they're used with pre-tax dollars. You have to be at least 21 years of age, and you have to have worked self-employed for more than a year or at least 1,000 hours. If you were contributing to this plan and you died, payouts could be available immediately to the beneficiaries of the plan. Now, if you became disabled and you had this plan, then you may collect benefits immediately from the plan. You may be able to use the plan's funds immediately, since there's really no disability usually for some self-employed people. They don't get it through their company or anything. Well, they could, but it may not be set up that way. Or you could just leave the money there to accumulate. If you entered retirement, you have to take the money out no earlier than 59 and a half. If you take the money before age 59 and a half, you get a 10% tax penalty on it. And then I think you either have to start taking contributions out at 70 and a half or 72. It used to be 70 and one half, but it may have changed to 72 is when you can take the money out. I would just Google that and check it, because those ages may change. Required withdrawal ages may change, but there is a 10% penalty if you take it out before 59 and a half, and you can stop paying into it at any time, and there's no penalty. Your funds will just keep accumulating. So this is just basically a retirement plan. It's called an HR10 or a Keogh plan, and it falls under 401c section of the tax code. So that's what you'll have to know the basics about it for your life insurance exam course. Basically that it's for self-employed individuals. It's with pre-tax dollars. You can put up to a specified dollar amount limit in there, or 100% of your income if it's lower than the specified dollar amount. It accumulates tax deferred their contributions until withdrawal. So then when you take them out, then the withdrawals are taxed. If you take them out before age 59 and a half, then you pay the tax on the withdrawal plus a 10% early withdrawal penalty. And the age used to be 70 and a half. It may be 72 when you have to actually start taking withdrawals.
Insurable interest, what it really means is there a reason for this person to get insurance? That's all that they're really looking for. What that means is that the person who owns the policy has to suffer a loss when the insured dies. Obviously, if the policy owner is the person who's getting the policy, then if I'm getting a policy on myself, then I'm sustaining a loss. My life is being lost. And my family is losing my income and my what I'm providing for them financially. However, there are some different little scenarios that may pop up with insurable interest, and this is important to know for your life insurance prep exam. For instance, I'll give you an example. Say there's a company, right? And a company has a key employee. Say this person is the CFO of the company. If that CFO leaves, that company needs money to replace that CFO. So to hire, recruit, go through a ton of applicants to find the right person, to train them, maybe any revenue that may be lost during the time when they're in that process. So that CFO provides something to the company where if that CFO dies, that company will be at a loss. So in that sense, there's insurable interest on behalf of the company to get life insurance on the CFO. If someone is getting a policy on their mom, so if I got a policy on my mom and I owned the policy, the loss I would suffer if my mom dies is that I would have to pay for her final arrangements, and I would have to cover any outstanding debts she has if I want to keep that property. The insurable interest on my end is, hey, I'm sustaining a loss if my mom passes away financially. The reason why this is important is because you can't just go get a life insurance policy on someone you don't know if there's not going to be a loss. Like, you can't just gamble with someone's life. They call that stranger-owned life insurance. We'll get into that in another video. A Stoli, not the vodka, it's life insurance. With insurable interest in life insurance, all it's saying, the concept is saying that, hey, if someone is being insured, the person who owns the policy must be sustaining a loss. So that's really what insurable interest is. It's an important concept to know. There may be some questions on the exam that may ask about what insurable interest is, or is there insurable interest in this situation. The beneficiary does not have to show insurable interest. Some banks will own a policy on someone who owes them money. If someone gets a huge loan out for, say, a several hundred or several thousand unit apartment building, the bank may get a life insurance policy on that person to pay back the loan, or at least a chunk of it, if the person dies. So there's insurable interest there. The bank's saying, hey, if this person dies, we're screwed. We want to make sure we get our money back. So that's another reason why. That's why a lot of local banks actually offer some life insurance, is because they're like, hey, if this person's got a mortgage or some loans with us, we want to make sure that if they die, their family can pay back their debts. So just keep this in mind as you're going through your life insurance career and the life insurance course, that insurable interest means that the policy owner would lose something if the insured dies, or they would take on a debt, or there would be some sort of expense. And insurable interest is part of the underwriting process. So the insurance carrier wants to make sure that there is insurable interest. So they want to make sure, like, hey, is this person getting the policy going to sustain a loss when the insured dies? Now, it can be confusing because a lot of times the person whose life is being insured owns the policy as well. Just keep in mind that that person is sustaining loss, their life is being lost, and they want to cover something. There is a financial loss too. Say the guy makes $100,000 a year, and he's like, hey, I want my family to have my income for the next 20 years, so I'm going to need at least $2 million of life insurance, and that doesn't count into inflation. That's insurable interest. It's saying, hey, this guy dies, and his income is being lost. There will be a loss sustained from that. It's another example of insurable.
Policyholders receive dividends and because they own the company. So there's no stockholders, all right? Meaning that the policyholders with cash value policies, like whole life policies with mutual companies, their cash value will grow faster. Dividends are not guaranteed, but they get them more often than not. Now, when it comes to being domiciled, a company can be domiciled as a domestic carrier. So like an insurance company that's domiciled and incorporated in Florida is a Florida domestic insurer. If it's domiciled in Texas and doing business in Florida, for example, it's called a foreign insurer. Business with an insurance company that's domiciled outside of the state, then it can be a foreign insurer. And if you're doing business with an insurance company that's domiciled outside the United States, it's called an alien insurer. Now, in order for an insurer or insurance company to conduct business in a state, transact business in a state, they have to receive a certificate of authority. Once they receive a certificate of authority, they are admitted or authorized, an authorized insurer. So you can have like a stock company that's a domestic company authorized in Florida. So they can all kind of go together. They're not like independent of each other. They are, but they can, names can be assigned to each one, right? So for instance, you can also have a stock company that is a foreign company authorized to do business in Florida. So if it's a stock insurer, stock-owned insurance company that is, say, domiciled in Texas, but it's doing business in Florida, and it's authorized, has a certificate of authority to do business in Florida, that would be a stock foreign authorized company, right? Stock company, it's a foreign company, it's authorized company, it's admitted. And then you have non-admitted or non-authorized, and those are companies that are not authorized to do business in that state. We're going to go over the definition of an insurance contract today. Now, the definition of an insurance contract is it's an agreement between the insured, who's usually the policy owner, and the insurer, which is the insurance company, where the insurer agrees to protect the insured if the insured sustains a loss. So in this case, the insured sustains a loss of life, so the insurance company agrees to protect them under that situation for a consideration, which means the premiums and then the statements on the application are the consideration for the insured. So the insurance company says, hey, under this insurance contract, I will protect you against the loss of your life and protect your family as long as you pay your bill every month, right? And that you told the truth on the application. Anything to do with the solicitation, which is selling, negotiation, which is like working the deal, the sale of, or the advising a client regarding coverage or claims of an insurance policy. Now, the reason why this is important, it sounds pretty basic and rudimentary, but the reason why it's important is because you need a license to transact insurance. So if anyone is soliciting insurance, negotiating the sale of insurance, advising someone what to do for insurance, or selling insurance and they don't have a license, then that is illegal. A joint life policy and a survivorship life policy. They both involve having 2 or more people insured under the same plan. So a joint life policy, for example, is when there are 2 lives insured, but after the first person dies, a benefit is paid out. An example of a policy like this could be a husband and wife both get a policy to protect their mortgage so that if one of them dies, the mortgage is paid off. So they could have a joint life policy. So in the event that either the husband dies and the mortgage is paid off for the wife, or the wife dies and the mortgage is paid off for the husband. After the death of the first person, the benefit's paid out and there's no longer a policy in force. The premium of this plan is based on the joint average age of the people. So it's based on the average age between the 2 people being insured. And obviously it takes 2 lives. It takes into account that 2 lives are being insured. Now, there's a little less risk for the insurance company in this case because it's between 2 different people dying instead of just 1. The premium for a joint life policy is less than the premium of each individual person added together. So for example, if husband has one policy, wife has another policy, the premium on each of those plans will be more combined than what the premium on a joint life policy would be on both of them, because the risk is spread out between 2 people for the insurance company instead of just 1. A joint life policy could also be used in the case of a business. So say there are 2 business partners and one says, hey, when you die, I want you to be able to, or if either of us die, I want the survivor to be able to hire someone to take over your role or be able to buy out that portion of the business from whoever inherits it or something like that. So joint life can also be applied to business as well. So remember, joint life is a first to die policy. A survivorship life policy is a second to die policy. So in this case, say husband and wife, they are involved in a survivorship life policy. If the first one passes, there's no benefit paid out. It has to be after the second one passes that the benefit is paid out. The policy premium on a survivorship life policy is going to be a lot less than it would be on a joint life policy. So you're going to have, I'll kind of give it an order of premiums here. So a husband and wife both have a policy on themselves, 2 separate policies. The combined sum of those premiums is going to be more than it would be on a joint life for a first to die policy if they were both in a joint life, or after one of them dies there's a benefit paid out. Now in a survivorship life policy, that's going to have the lowest premium of all of them because the insurance company says, okay, after the second person dies there's going to be a benefit paid out. So it's taking into account 2 life expectancies. So since it's going to take them longer to pay out, assuming they don't die at the exact same time, which usually doesn't happen, right? And hopefully for the family it doesn't happen either. So in a survivorship life, it's going to be a little bit cheaper. So the most important thing that you want to take out of this is that in a survivorship life, it's a second to die benefit payout. In a joint life, it's a first to die. And the premiums will be lower on either of them than what the sum of the premiums would be if each person had separate policies. And the premium is based on the average age of each of the people. So the whatever the age is, if one's 60 and one's 80, it'll be based on 70 years old.
Insurance. So key person insurance is usually for a business, and actually it's always for a business. And the way it works is that a company gets insurance on one of its employees to make sure if that employee dies, they have money to train a replacement and also replace any money that the company loses from that employee dying and not being able to generate revenue. Say someone is like the CFO of a company and they're in charge of the finances, and the company says, well, this employee essentially is responsible for, $2 million of revenue generation for us in a year, and we would probably spend 3 months looking for a replacement, and we'd have to interview people and pay people to interview them and hire a recruiter and a headhunter and everything else. So they say, hey, well, in that 3 month time, it'd say it costs us $500,000 to hire someone between loss of revenue and who they have to hire to find that person in the interview process and everything else. So they would get a key person policy for $500,000 on the CFO so that when that employee dies, the company can replace that person and not really lose out on the money that person would have been bringing into the company. So all a key person policy is when a business owns a policy on one of its employees so that they can pay the bills of hiring someone new to replace that employee and then also cover any lost revenue.
Specific amount every year until it runs out, okay? And then you can also receive a lump sum in cash. So those are the different settlement options that you can use for a death benefit. I hope this helps you pass your life insurance licensing course.
Now, this is off the course material in the state of Florida, so this may or may not completely pertain to whatever state you're in, but I would watch it anyway because it's probably very, very close, if not the exact same in every different state. Some states, life settlements and viatical settlements are regulated, some they're not. They are regulated in Florida. They're actually regulated in most states, but even if they're not regulated in that state, you're probably gonna have to learn about them anyway, so keep watching here. Now, a life settlement is a transaction between the owner of a life insurance policy and someone else, and someone who sells that policy for cash. This is different than a viatical settlement in the sense that most of the time in a life settlement, the policy owner, or actually the insured, is healthy. Usually in a viatical settlement, someone's super sick and they have to get rid of the policy real quick so they can get some money, right? So they sell their policy to someone else who will then later claim the death benefit so that they can get less money up front because they really need it because they're sick and they need to handle some affairs. Life settlements, I guess a viatical settlement could be a type of life settlement in a way. A lot of times the quote unquote life settlement comes into play when someone's usually healthy, so they don't need the insurance anymore. An example, say I sold my insurance agency for $1 million, $5 million say, and I had $1 million life insurance policy. I may not need that $1 million policy anymore because look, I just got $5 million for the agency, so I don't really need that much of a cushion. Okay, so I'm gonna say, you know what, I don't need this anymore. I've been paying into it. I'm just gonna sell it. The amount that would be given to me for my $1 million life insurance policy would be based on my health and my age. So it's a sort of like underwriting, quote unquote, where they say, okay, you have $1 million policy based on how old you are and how healthy you are. We're going to give you this amount for it. And that company who pays me for the policy has to just keep making the payments. Now, what I do, I transfer all rights to that company. So it's an absolute assignment of policy ownership being transferred from me to the other company. Now, there's some definitions you may want to know. There's a definition, business of life settlement, which pertains to any activity relating to the solicitation or sale of a life settlement contract. Okay, next is the owner. And the owner in a life settlement contract is actually the person who owns the policy that wants to sell it. The provider is the person who is providing the cash to buy the policy from the owner, okay? So if I am the owner of my $1 million policy, the provider is gonna come in and give me the money for it. The insured is the person who is insured under the policy. So say my business owned that policy, I am the insured, my business is gonna sell it to that other person. Life expectancy is essentially how long they think someone will live based on their medical history and other mortality factors and just other factors at play, like gender and stuff like that and age. So it's how many months do they think I'm gonna live? They will pay me a certain amount of money, and then they're gonna keep making premium payments on that policy. And when I die, they are going to get the $1 million from the policy. So there's a life settlement contract. So there's a death benefit, there's a policy ownership, and beneficial interest. The death benefit is obviously what the person receives when the insured dies, and the policy ownership gets transferred to the person or entity that is buying the life insurance policy. Okay. Life settlement broker is the person who negotiates and sells the life settlement. They get a commission for it and they only represent the policy owner. So they would represent me. So a life settlement broker would represent me to go find someone to buy the policy and give me the money for it. Okay. They represent me and they get a commission on it. And then a life settlement provider is a person who enters in a life settlement contract with the policy owner. So life settlement broker, looking in my best interest, will want to get me as much money as possible. And if they make a percentage of that payout that I get, then obviously they're looking out for my best interest, trying to get me as much money as possible. So that's the basis of a life settlement contract. So in summary, you own a life insurance policy. You don't really need it anymore for whatever reason. I want to sell it to someone else because I don't need it anymore, right? I got $1 million policy. I just came across a ton of cash. I don't need $1 million policy anymore. I am going to sell this policy to someone else who would be a provider through a life settlement contract, and they are going to assume all ownership rights to the policy. They're going to keep paying the premium. They will receive the death benefit claim when I pass away. I am still the insured. Long-term care riders. So a lot of the riders that help with long-term care do cost additional premium. However, there are some that don't. Now, what these riders do is they allow the insured to receive some of the death benefit in advance before they pass away if they are ever in a long-term care situation like nursing home, skilled nursing care, something like that. Typically, there is a certain period that they have to be in the nursing home for before this benefit will kick in. So it's not like, hey, you're in a nursing home today, cool, we're going to start this benefit tomorrow. It's usually like you have to be confined there for anywhere from 30, 60, or 90 days. And then the doctor has to say, yeah, they're permanently going to be here before these riders will kick in. Sometimes they'll actually waive the premium. Okay, so there can be a nursing home waiver of premium, where if they're in a nursing home, the premium gets waived, just as in like a disability waiver of premium rider. What happens is they're in a nursing home for a certain amount of time. They make those payments while they're in the nursing home. Once that qualification threshold passes where, hey, once you've been here 90 days, then we're going to start covering your payments. It will refund the premiums paid and then cover the premiums moving forward for the nursing home waiver of premium. Now, there's a long-term care rider which will advance some of the death benefit if the insured is in a nursing home. Sometimes these cost money, sometimes they don't. The long-term care rider that will advance some of the death benefit, how that works, they have to be in the nursing home for a certain amount of time before it kicks in, and then they will be advanced some of the money either in a lump sum, which some policies have, or in a monthly income check. So some policies say, well, we're going to advance you 50 to 100%, whatever they want, of the death benefit if you're in a nursing home permanently. Or they can say, we're going to give you like 5% of the death benefit every month until it's exhausted or you want to stop the payments. With any of these riders where the death benefit is accelerated to the client ahead of time, the remaining death benefit, once the insured passes away, is essentially the original face amount minus any outstanding loans or minus any money that was taken out of the policy for the advancement of the death benefit, minus any interest either from a loan or from what the company would have lost by advancing that death benefit. So what I mean by that is we'll just use the death benefit interest as an example, or the accelerated death benefit interest as an example. So say they have a $100,000 policy and they end up getting advanced $50,000 because they're terminally ill or in a long-term care situation, and they elect to get that money ahead of time. Well, the company is also losing out on the interest that money would have earned. Okay, because life insurance companies make their money by taking the premiums and then investing them and earning interest on their investments, right? The company, obviously, if they advance you 50,000 of that 100,000, then they're losing interest on that 50 grand while they gave it to you while you're still alive. So they want some of that interest back. So every company's got a different policy on how much they take back. Usually they want all of it that they would have lost back. Misrepresentation is essentially when you lie about something on a policy, or you give false, misleading, and deceptive information about a policy, its features, its benefits, things like that. An example, there are things called dividends, and dividends are earned through participating whole life policies with mutual insurance companies. Dividends are not guaranteed because technically it's a return of unused premium, and companies pay dividends when their profits are higher than they expect and their expenses are lower than they expect, because the company may have higher expenses one year, they may have less profits one year, so dividends are not guaranteed. So if you told someone that dividends are guaranteed, that's an example of a misrepresentation. Another example of a misrepresentation is showing someone an illustration or a graph or a diagram of a policy that is, say, a variable policy. So say it's invested in the stock market and you're saying, hey, this fund is going to gain 8% per year, then you showing that on an illustration is a misrepresentation because it's not guaranteed. If you say it's guaranteed, hey, this is what it's going to look like for you in 30 years with this account. That's a misrepresentation. It's illegal. You can't tell people things are guaranteed when they're not. You can't tell people that their policy has features that it doesn't. You can't tell people that it doesn't have features that it does. So you want to make sure that you disclose everything about the policy to your client so that you're not misrepresenting any facts. We're going to cover MECs, modified endowment contracts. What this is a life insurance policy, a whole life policy that someone put too much money in. Back in the day, before this was a rule, I think in 1984 it became a rule, wealthy people used to just use high life insurance policies as high interest cash accumulation vehicles. And the IRS said, no, this isn't intended for that. It's intended to make sure that if someone dies, their family's taken care of, and that's why they get the tax advantages. You're just using it for your own personal benefit and greed, not for the aid of the family, your family when you die. What they said is they're going to make a rule called a 7-pay rule. Now, what this means, it limits the amount of money that can be put into life insurance policy in 7 years. And if the policy violates this rule, it becomes a modified endowment contract. So there's a cap on it. They say, hey, in 7 years, there's a maximum amount of money that you can put into this policy. If more money goes into it than you put into it, then it loses its tax advantages and becomes a modified endowment contract. Now, you don't have to know exactly how the math works and everything to pass your life insurance pre-licensing exam, but that is the basics of it. If you put too much money into a life insurance policy, then it becomes a MEC, modified endowment contract. What happens is if you take distributions from a modified endowment contract before the age of 59 and a half, there's a 10% tax penalty. The growth does happen tax deferred. However, all the distributions are going to be taxable at first. So the way that most investments work when you withdraw money from them, it's a first in, last out basis, meaning that you withdraw the principal first of what you paid in premiums, and you don't pay tax on that, and then you only pay tax on the gains. So it's like if you took a partial surrender of a life insurance insurance policy. Say you put in like $10,000 into a life insurance policy and there's $20,000 in cash value. If you took $5,000 out of that, you've already paid in 10 grand. So you're not going to pay tax, right? Because you had 10,000 in premiums you've already paid in. But if you took out 15,000, then you'd pay tax on the $5,000 in excess of what you paid in. Okay, so if you paid in 10 and there was 20,000 in cash value and you took out 15, you pay tax on the 5, right? Because there's 5,000 more than you put in. But if you only took out 5, then you're not going to pay tax on that because you put in 10 total. Okay, 10,000 total. With a modified endowment contract, the way that withdrawals work is that they do it backwards. So they say, no, you're gonna have to withdraw the gains first. Anything you withdraw first is the gains. So you're gonna pay tax on it first before you can withdraw any of the principal. So they kind of like reversed it and they really disincentivized, I don't know, whatever the word is, people doing that. So that's basics of what a modified endowment contract is. Waiver of monthly deductions rider is typically associated with universal life or variable universal life policies. Now, what this does in a universal life and variable universal life policy, there are charges that are built in. There are insurance expenses, premium loading charges. There's all these different expenses that are built in. And riders, it will cover those, but it won't pay any additional premium that would accumulate cash value. So if you remember, universal life policies have a flexible premium. So you can pay just enough to get by and cover the expenses, or you can pay more and it will increase and start accumulating cash value. So this waiver of monthly deductions rider is for universal life policies. They say, hey, if you're totally disabled for 6 months or more from doing your normal job, then we are going to start to cover the base premium for you and refund you the previous premiums that you paid while you were disabled, and we'll cover them. And then after 2 years, if you can't do any job at all after 2 years, not just your own job, then we will still continue to cover them. So for the first 2 years, it's if you can't do your job, if you're disabled, and after that, it's if you can't do any job at all. This rider typically costs money, right? Because the insurance company's taking a risk that they're not going to get premiums anymore on this policy, but it's designed to cover the base amount to keep the policy in force, not the amount that's needed to accumulate cash value. Okay, so if someone's paying $400 a month on their universal life policy and it's accumulating some extra cash value, they're paying extra and they're permanently disabled, the insurance carrier is not going to continue to pay that inflated premium. They're going to pay the minimum amount needed to keep the policy in force. So cash value won't accumulate anymore or anything like that, but it is designed to, hey, if you are disabled, we're going to make sure that the expenses in the policy at least get paid so that your policy is not going to just collapse on you while you're disabled. And the insured has to prove that they're totally disabled, and then after 2 years, they have to prove that they can't do any job at all based on their previous training, education, or experience. I'm going to cover non-forfeiture options with whole life insurance policies as you'll need to know them for your life insurance pre-licensing exam. Okay, so non-forfeiture options have to do with whole life insurance policies. This is because there's cash value. So what a non-forfeiture option is, it's essentially an option that you can exercise when the policy is finished, whether you surrender it or it lapses or you cancel it or whatever it could be. There are a few different options that people have because there is money available in the cash value. So it's not like that money just disappears. Okay, now there's 3 options. There's cash surrender value, there's reduced paid up insurance, and then there's extended term. Those are the 3 non-forfeiture options. Now the first one, cash surrender value. What that means is if you have a whole life policy for life insurance, it has cash value that builds up over time. So there is a cash portion of it. So say after 5 years, you have $5,000 in cash value that you can access if you would like to borrow against it with a policy loan. You can take a loan against the money, or you could surrender the policy for that whole value of that whole $5,000 value. That's one of the options, cash surrender value. Now, if you do surrender and you take all the cash out, then you no longer have a policy in force, and there is a small surrender charge that's associated with that. It's usually very minimal. And then also, though, if your cash value is more than the amount of premiums you paid in, you have to pay tax on the excess amount as ordinary income tax, right? Because you've actually gained money on it. Those are the things that you want to know about for the cash surrender value. So say I have a policy, I've had it for 5 years, I have a $5,000 of cash value in there, I can surrender it. I can surrender that $5,000 and take it. The whole thing, I no longer have a policy in force. I can't reinstate the policy. If that $5,000 is more than what I've paid in, then I have to pay tax on the difference. So say I only paid $4,500 in premiums and I have $5,000 in cash value. I have to pay income tax on the $500 difference, and the surrender charge is applied to that, which is very minimal. Now, the next one I'm going to talk about is called extended term. So say I have a $50,000 whole life policy, okay, $50,000 face amount, and I have $5,000 of cash value in there, and I want to exercise the extended term non-forfeiture option. what this means is that I'm going to get a term policy for $50,000. So you take a term policy out equal to the face amount of the permanent life insurance policy, and the cash value pays for that policy for however long it will pay for. So say I have a $50,000 whole life policy with $5,000 in cash value, and I want to exercise the extended term. Let's say that $5,000 would just buy me 12 years, $50,000 term policy. Then I can say I want to exercise the extended term option with this cash value and no longer make payments on the policy. So in that case, I'd have an extended term policy. I don't know if this is confusing to you guys, but essentially what we're doing is we're taking the money that we have in the cash value and we're using that to prepay for a term policy. And however long that cash value prepays for that term policy is however long that you have the term policy in force. And after that, the policy's over. The last one I want to go over is the reduced paid up option. So the reduced paid up option, what that lets you do, say you have the same $5,000 in cash value. You say, hey, I want to take that $5,000 and purchase a paid up whole life policy with that. So say it goes down to like a $8,000 permanent whole life policy that you no longer have to make premiums on. So you say, I'm going to stop making my payments, and I'm going to take a reduced paid up option right here. I'm going to use that $5,000 to purchase a $8,000 whole life policy that's going to keep earning dividends. It's going to keep gaining dividends if it's in that type of policy. It's going to keep gaining cash value, and you never have to make another premium payment on it. So you're taking that $5,000 cash value and you're doing a lump sum single premium payment on a whole life policy. So some whole life policies you pay monthly, some you pay annually, some you can pay just for 10 years and everything's paid up. This is for a single premium. So saying here's that $5,000 in cash value. I'm going to use that to pay for a whole life policy. Whatever that amount covers to have it fully paid up, I'm never going to have to make another premium on it again, another premium payment on it again, and it's going to keep increasing in cash value. That's it. It remains in force until maturity. That's the basics. Those are the three non-forfeiture options we have. The cash surrender value, we have extended term, and we have the reduced paid up option.
I'm going to talk about completing the application here. There's two parts. There's the general information part and there's the medical information part. Part one is general information, like the client's name, their date of birth, street they live on, their address, their age, their gender, their income, their marital status, maybe social security number, maybe bank account information. This is just like general information about that person. A lot of it's identifying markers and things like that. Okay, maybe beneficiary info, information on any existing coverage, how much insurance that they're applying for, what type of insurance they're applying for, their occupation. Those are all things that are included in the general information part of the insurance application. And then the second part is the medical information section. It consists of their medical backgrounds. It includes their own health issues, maybe their prescription history. It may have some familial family stuff. Maybe they had some family members who had cancer, why those family members died, things like that. Different policies have different things that they look for. Higher face amount policies are usually more extensive with the checks that they look, how deep they go into the health information. Small face amount policies, 99% of the time, it doesn't require medical records or anything like that. So for smaller policies, I'm talking like $50,000 or less, the agent completes the medical part of the application. And what that usually consists of, if it's a smaller face amount policy and the agent is doing it, right? It's called a non-medical application, meaning there's no medical exam, no blood tests, anything like that. It's just the agent asking the client some health questions. They're usually yes or no questions structured around like, hey, in the last 3 years, have you had a heart attack? Like that's just an example, right? Not every application with every company asks the same questions, but with those smaller policies, the insurance agent acts as the underwriter for the insurance company. That's why they're called field underwriters. Very important term here. You want to remember field underwriter. So for those smaller face amount policies, the insurance company trusts that the insurance agent's going to go out there. They're going to ask the right questions. They're going to ask the questions on the application. And they're also on the front lines. The agent is. So if you ask the client if they smoke and they say no, and their house smells like cigarettes and they live by themselves, or maybe who they live with is like an Olympic athlete or something, right? Then you're like, okay, well, maybe this person actually does smoke. That actually happened to me once. So that's why I'm bringing it up. I went to a client's house. It was a smaller face amount policy, so it didn't require any extensive medical background checks, just some basic questions. Then at that point, I asked the lady if she smoked. She said no. And then her house reeked like cigarettes, and there was cigarette smoke when I walked in, and she lived by herself. myself. I'm like, is anybody over here today? No. I'm like, okay, well, you smoke. You know, I don't care what you say. You smoke cigarettes. So I put down that she was a smoker on the application, even though she told me she wasn't, because I knew she was. That's where you as an agent run the front line for the second part of the application process, for the medical. The insurance company is relying on you to be the underwriter and to help them assess what risk that client will pose to them based on their health. You're called a field underwriter in that sense, and that's a non-medical application or a non-med. It's also called simplified issue because it's a simplified application. Okay, now the larger face amount policies that these big companies do, these are big face amount companies where someone's going to get a multi-million-dollar policy or many hundreds of thousands of dollars or whatever. Every company's got their own specifications. But the larger face amount policies, the agent typically does the general information part of the application where they get the basic stuff. Then the insurance company usually handles the back end medical stuff. The insurance handles the insurer handles the medical. That could be, depending on how big the policy is and what they're trying to figure out, it could need a blood test done. They could need a urine sample. They could do a cheek swab. They could request 10 years of medical records. They could request a bunch of stuff to determine that client's eligibility for insurance. That's one of those bigger policies. That's where the insurance company handles the medical part, because they're saying, hey, we're going to take this. We're going to send someone out there. We're going to run some tests on them, height, weight. We're going to send someone from the insurance company out to make sure that this person's A-OK, good to go for this policy. And we're going to assess the risk from there. What insurance companies use, they use the Medical Information Bureau. This is a very popular term in life insurance, the MIB it stands for. The MIB is a company that compiles a ton of data to help life insurance companies evaluate the risk of the client. So when you go to the doctor, say if a client had a heart attack, well, the doctor puts a note in the system recognizes that code, say the code for heart attack is like 5412. When the insurance company runs the MIB check, they can see that person's medical history if anything has been entered into there. So for those non-medical applications, there's a lot of MIB checks. There are MIB checks for medical applications as well, where they do the extensive background. But how does the insurance company know if the agent's telling the truth or if the client's telling the truth? They do check the medical history for the most part, and then they do check the prescription history, right, to make sure that the client's telling the truth. So they can see a lot of the client's health information that's entered into the MIB. But if they need further information or if it's a larger policy, they're going to request the actual medical records themselves to make sure that they're not missing anything. So there are some basic checks that an insurance company can do on someone's health without having to get their doctor to send them the file, essentially. If you do have to run a medical when you are out in the field selling insurance, I mean, your clients have to do a medical part. Make sure you follow up with it. If the doctors aren't sending the information out, make sure you follow up and you help them get that information. So the agent is the field underwriter. They are the front lines. They are in the field underwriting for the insurance company. The agent makes sure that there's proper prevention of adverse selection. So like I was saying, the agent makes sure that, hey, is this person applying for insurance? If they say that they are healthy, height, and weight, are they really healthy, height, and weight? Okay, you also make sure that the application is done properly for the insurance company. They rely on you to make sure that you're completing an application in the proper way. They make sure that any further questions are asked. If the client are prescribed a medication and you look it up and that medication comes up that it could be a cancer treatment. There's a popular medication that's for arthritis and for cancer. So you look, you say, oh, whoa, hey, hold on. Do you have cancer? No, it's for my arthritis. Okay, you can put that in what's called an agent statement or a producer's report. It's not going to be on the final policy contract, but it's just notes that you can make to the insurance company on the application to explain certain situations that may come up. Also, you make sure that the initial premium is collected. The insurance companies, they want their money. Or when you have a client apply, the goal is to get a payment with the application that day. It drastically increases the chances of the client paying their bill on time and actually keeping the policy. The client is legally obligated to make their payment, but the insurance company is obligated to make the claim as long as the client pays their bill. You try to get that first payment from the client so that they'll keep paying their bill. When you get the initial premium, the best way to get the payment is with the application. So when you apply, say, okay, you get a check or you have them fill out when you're filling out an application online, a lot of insurance carriers have an electronic application now. You can just put their checking account routing information on there. That's better than a debit card. When you get a payment receipt is something that you'll have to issue for the initial payment to the client. Usually the companies have their own version of that. It can be on the application that gets sent to them, and they'll give you ways to do that where you can give someone a payment receipt. There's also a conditional receipt. So a conditional receipt is just saying, hey, we are saying that your policy starts today or whenever your medical exam, if it requires a medical exam, is completed, right? Whichever comes last, the application date or the medical exam. Whenever that's completed, that's when your policy will be in effect, assuming you get approved as applied for, all right? So if a client applies for the best rate for a big amount of coverage, they make the payment, the first payment with the application. Every company looks at this a little bit differently, but in general, the company is saying your coverage will start. You did the application or you completed the medical exam. As long as you made your first payment and you get approved as applied for, your coverage starts then. Now, if they get declined or approved otherwise, then obviously that could change things, all right? But usually there's a condition or receipt. It's just saying, hey, you are going to get approved for insurance under the condition, you have coverage now under the condition that everything comes back as applied for. Some companies, their conditional receipts will say, hey, you have coverage, and if you die before the policy is officially approved, then we will still do underwriting, and if we can complete it, your claim will be paid out based on whatever you'd be approved on at that time. So every company runs a little bit differently, but for the insurance course, they want you to feel like in general that if someone makes a payment with the application, the company considers the policy in force upon the application date or when the medical exam is completed, if it's required, whichever came last. So if they apply with the payment, then they have to do a medical. The medical exam would be the official coverage start date, right? Because that came last. That is called the conditional receipt. So if the person applies and makes a payment, they can get a conditional receipt saying, hey, either whenever you applied or, sorry to keep going on about this, but I want to make sure you guys understand this. If a policy takes 6 to 8 weeks to get approved, the person wants to make sure that they had insurance during that time, right? So the company can say your insurance coverage started on your application date or whenever you got the medical, assuming that you do end up getting approved as applied for. That's all that's saying. So it's like a tentative approval, a probationary approval. You have to make sure as an agent that you get the signatures on the application and your signatures, the insured signatures. A lot of time the person who is being insured, meaning their life is insured, also owns the policy and is paying for it. But there may be other situations too where say a parent is getting an insurance policy out on their child. The parent signs for the child and the parent's paying for it, even though the child's the insured. And if they're a minor, they can't sign the application, right? So in that case, the parent would sign for the child. Or if a business is getting life insurance on an employee, then the executives of the business or whoever has the chairman position they own the policy. So they sign as the owner, they sign as the person paying the bill. The person whose life is being insured has to sign as well, then the agent has to sign. Also, you're going to make sure all the questions are answered on the application, and if they're not answered correctly, the insurance company is supposed to send the application back for the person to finish. So you as an agent have to make sure every question gets answered properly on the application. Now, if the insurance company approves the policy without a question answered, then the insurance company cannot deny a claim based on a death for a reason of a question that wasn't answered. So for instance, say it says, did you have a heart attack in the last 3 years? And that question is not answered on the application, and the insurance company approves it for whatever the person's applying for, and then the person dies a couple years later, and the insurance company can't say, well, that question wasn't answered, and we didn't know that they actually did have a heart attack in that time frame we asked, so we're going to decline it. They can't do that. So they have to make sure that everything is answered properly. And lastly, replacement. Someone has an existing life insurance policy and they're replacing it with another life insurance policy. You have to make sure that all the documents are gathered properly. Like all the documents have to be gathered properly because it's not always in the client's best interest to replace one policy for another. You'll learn this as the course goes on. If a client has a life insurance policy and they're canceling it to get another one, sometimes it's in their best interest, sometimes it's not. So you have to make sure that the proper documents are completed for a replacement, or else you can get in big trouble. It could be unethical and you could get in trouble for that if it's not in the client's best interest to actually replace that policy.
What I'm going to go over here is the U.S. Patriot Act and anti-money laundering. This is an important part of your insurance exam. The Patriot Act was essentially established to set new standards and procedures to monitor potential money laundering for terrorist activities. The USA Patriot Act was signed in, I believe, October 26, 2001. The U.S. Patriot Act
required FinCEN, which is the Financial Crimes Enforcement Network, to establish new anti-money laundering policies for banks, securities firms, and insurance companies got incorporated into this because people can give insurance companies a ton of money. So they want to make sure that the money is coming from a valid source, from a legitimate source, that someone's not laundering the money, right? Because you can see how it would be easy if someone puts like a ton of money into an annuity or an insurance program and then cancels the program and asks for a refund. Essentially, the insurance company is then writing them a check for that money they're getting back, and it's cleaned money. So federal government wanted to monitor and make sure that insurance policies and annuities were not going to be sources of money laundering. So FinCEN requires insurance companies to monitor all financial transactions, report any suspicious activity, and prohibits correspondence in working with foreign shell banks. Insurance carriers also, because of this Patriot Act, are required by FinCEN to incorporate strict customer identification programs and customer identification verification processes. So part of the anti-money laundering program includes the following. They've had to assimilate policies, procedures, and internal controls for in-house risk assessments, meaning the risk assessments have to be done in-house by the insurance carriers. They've had to institute anti-money laundering programs similar to banks and securities firms. They had to file suspicious activity reports, or SARs, if there are suspicious transactions, which we'll get to in just a little bit. And they've had to appoint qualified compliance officers to monitor the anti-money laundering programs. So these insurance carriers have had to hire people to specifically monitor and make sure that these anti-money laundering programs are compliant and that they work. Also, insurance carriers have had to implement continuing education courses for anti-money laundering so that their agents and staff understand what the policies and procedures are to monitor money laundering and follow the anti-money laundering rules under the U.S. Patriot Act. The insurance carriers also have to allow for independent testing of their anti-money laundering program on a regular basis from outside sources. So there are a few rules for filing suspicious activity report. So suspicious activity reports were implemented to make sure that if there's any potential suspicious activity going on, that the insurance company could file a report saying, hey, there are some transactions here that seem a little fishy. Now there are some rules to when you have to file a suspicious activity report. So it's any transaction over $5,000 if the insurance carrier knows, suspects, or has reason to believe the following: that the transaction has no business or lawful purpose, if it's designed to deliberately misstate other reporting constraint, if it uses the financial institution or insurer to assist in criminal activities, if it's obtained using fraudulent funds from criminal activities, or if it's intended to mask funds from illegal activities. So essentially, any transaction that's $5,000 or more where the insurer has reason to believe that the money was obtained from illegal means, or it's being used to kind of move around something, or it's just suspicious and fishy, like it's just a weird situation. Now, with the weird situation, there are some red flags that the insurance carriers are going to look for, and that you'll want to look for as an agent if you're dealing with people who are giving you large sums of money, $5,000 or more. Number one, if the customer uses a fake ID, or if they change their mind after they realize that they have to give you an ID. If two or more customers use similar IDs, right? If people are using IDs that look the same, or they're trying to use the same ID. If the customer conducts transactions that fall just below the constraints. So say they're like, I'm going to give you a deposit for $4,999.99. It's like, why didn't you just give me $5,000? Because that's the threshold for the suspicious activity report. So that's a little fishy. Another thing is if you have two or more customers trying to work together, if the insurance sees two or more customers trying to work together to break up transaction, right? It's like if two people want to go in and give a certain amount of money for something so that each of them falls under the total threshold that would allow them to, that would require a suspicious activity report to be filed if the insurance company thought it was suspicious. So when you have a couple people working on the same transaction and breaking it down to kind of try to evade minimum requirements. Another one is if the customer uses two or more locations to deposit money or withdraw money or send money in the same day so that they can break up their transaction to fall below the reporting threshold. So if they use, like, say they wire the money with one bank and then they wire the money with another bank and then wire the money with another bank, it's like, why didn't you just send it all with one bank, right? Now that all these reasons, they don't require you to file a suspicious activity report. They don't require the insurance insurer, I should say, to file a suspicious activity report. But it is something to look out for, where if these things come up, it's like, hey, why did this happen? And if it seems kind of weird and fishy and the person can't really explain like why they did some of these things, then it may warrant the insurance company to file a suspicious activity report. So these reports take place on FinCEN, which is the Financial Crimes Enforcement Network, Form 108, and the reports must be filed within 30 days of discovery of the suspicious activity.
So the pay or benefit, what it means is when a person has a policy on a minor, parent has a policy on their child and they become disabled, what it means is that the insurance company will waive the premiums on that policy until the minor becomes usually 21 years old. Sometimes it's 18, or it could be any age, but normally it's 21 years old. This means, hey, mom is paying for a whole life policy on her son. Mom becomes disabled. Son doesn't have to worry about premiums getting paid on that policy until he's 21, and mom doesn't have to worry about it either. Now, totally disabled means you can't do your own job, okay, at all. Mom has to be totally disabled from doing her own job for 6 months before this kicks in. She has to prove that she can't do her own job. She has to pay those first 6 months of being disabled. After that, if she's still disabled, the insurance company will refund those premiums that she paid during the first 6 months of her disability and continue making payments until she is able to work again. Then after 2 years of being disabled, the insurance company says, okay, now it's no longer are you disabled from doing your own job. Are you disabled from doing any job at all based on previous education, training, and experience? So they're pretty much saying, like, can you function as a somewhat normal member of society? Like, are you anything but brain dead, right? It's really the only reason why they would cover stuff. Any previous education, training, and experience means, like, did you learn some basic stuff that you can do basic work for? They're a little bit more strict on this after 2 years. In the first 2 years, it's can you not do your own job? So if mom's a mail person, she goes and delivers mail and she hurts her hip and she can't move around and walk anymore, she can't do her normal job. After 2 years, just because she can't move around or walk anymore doesn't mean that she maybe couldn't sit behind a desk or something somewhere and do other type of work. So at that point, it may not kick in anymore because it says, hey, yeah, you can't do your regular job, but you can do any job. It's not like you can't do any job. Now, if mom got in a car accident in the mail truck, heaven forbid that ever happened, and she became like kind of mentally dysfunctional, right? Brain damage. Then in that case, of course, it's total disability. But what this is designed for is that if someone takes a policy out on a minor or on third party, on someone other than themselves, then they are protected from paying that policy if they are disabled. This rider does cost money, and it's added to a policy just like you add a tie to a suit as an accessory.
Okay, there are a few distinct characteristics of an insurance contract. One of them is it's a contract of adhesion. So a contract of adhesion means that usually like one party in the contract has substantially more power than the other party. So in this case, the insurance company has more power. They prepare the contract for the insured. Now, the insured can either take it or accept it. They can reject it or accept it. So that's a contract of adhesion. It's like, hey, this is what it is. Take it or leave it. The insured has little to say about the provisions in the parts of a contract of adhesion. So the biggest thing you want to realize is big guy, little guy. Big guy prepares it. Little guy can accept it or reject it. We have the insurer and the insured. Okay, that's the contract of adhesion. The next characteristic is that it's an aleatory contract. So it means there's unequal exchanges. So in an insurance policy, in a life insurance policy, what it is the insurance company is going to pay a massive claim, and all the insured has to make is one payment. So a life insurance policy can be like, hey, for this term policy, you're going to pay $100 a month. If you make one payment and die, we're going to pay you, your beneficiary, whatever many hundreds of thousands or millions of dollars it is for the life insurance policy. So a unilateral contract means that one party is legally bound to do something and the other party is not really legally bound to do anything. So in a life insurance policy, the insurance company is legally bound to pay the claim if the insured dies as long as they're making payments. But the insured is not legally bound to make their life insurance premiums. If they don't pay the premium, then the policy just goes away. So that's where it's a unilateral. The insurance company is the only one with any legal obligations to do anything. That's pay the claim if the insured dies. The insured, as long as the insured pays their premiums. So the insured is not legally required to pay their premiums. And then the last aspect of it is a conditional contract. So conditional contract means that some conditions must be met before the claim can be paid. This is how it applies to insurance contracts. So it means that the insured or the beneficiary typically has to show there was a loss. So they have to show the death certificate, like the person has to die for it to be claimed. That's the condition. So it requires certain conditions be met by the policyholder. So In this case, I mean, I hate to laugh, but they're going to die, right? You're going to die to get your claim for life insurance. If it's health insurance, it's you have to be sick, right? Or you have to go to a doctor and they have to diagnose you with some illness to file the claim. That's the condition that must be met.
Today, we're going to talk about policy loans and withdrawals. So let's just get right in. Now, a policy loan is only available in policies that contain cash value. You can take out a loan from the insurance carrier in an amount up to maximum of whatever the cash value equals. Now, since it's a loan, it's not taxed as income. Okay, that's why a lot of people will like life insurance policies as tax safety nets or tax havens, because you can take out the money and there is no tax on it since it's a loan. However, there is interest to that loan that you can use to pay that loan over time. So when the insured dies, any outstanding balance on the policy loan comes out of the death benefit. And a policy loan can only make a policy lapse if the loan is greater than the amount of cash value that the policy has. So let me go over that again here. Say the death benefit is $1 million and they have a loan against the cash value for $100,000. That means when they die, that $100,000 comes out of the death benefit and any outstanding interest. And say that the cash value in the policy is $200,000, and because they're not making payments back on the loan, the interest brought that $100,000 cash value loan up above $200,000, then the policy can lapse. Now, loan requests can be deferred, but they usually aren't. Now, what that means is the insurance company can defer the request for the loan, I think for like up to 6 months or something like that. There's another type of loan called an automatic premium loan. Now, an automatic premium loan is never, the loan is never put off. What this is, it allows the insured a safety so that they won't lapse their policy if there's enough cash value in there to pay for a premium. So say they miss their premium, and the grace period expires. Instead of the policy lapsing, if there's enough money in the cash value to cover whatever their premium is, then that cash value will cover that premium. So some people actually use this as a way, once their cash value gets big enough, there's enough interest accumulating on that money to pay for the premium itself. Okay, so say like that $1 million example I had before, say they have $1 million policy and it's $1,000 a month, and say they have $200,000 in cash value and they're earning enough interest to pay a big chunk of their premium, or maybe pay the whole thing. They're earning enough interest to pay the whole thing at that point. Now they can just use that interest to pay off their premium, or take some of the cash value to pay their premium instead of having to pay it out of their pocket. So that's just an option that some people have, but companies have this in place to help prevent the lapsing of a policy. So here we covered policy loans, the basics of it in a policy provision, and now there is an interest rate, a minimum interest rate that is charged to the loan. Every company varies on what their interest rate is. I'm not going to say what the rates would be because that may date this video, but there is an interest rate, and that is in the policy. Usually it says what the interest rate will be if they borrow against it, and if someone needs to find out, they can always just call the company and figure it out. But there is an interest rate on any money that's borrowed as cash value. So as you're paying back the money that's borrowed from the cash value, you also have to pay interest on the loan. The first thing I'm going to cover is premium payments. Now, premium payments have to do with paying for your life insurance policy. Now, there are different modes of paying the premium. So when you hear modal premium, it means how is that payment being paid? All this really means is, are you paying it monthly? Are you paying it annually? Are you paying it semi-annually, like every 6 months? Are you paying it quarterly, every 3 months? So premium mode is just the frequency. How often are you paying that premium? If you pay it anything more frequently than annually, you usually have to pay a little bit extra, because what happens is there's administrative costs and there's actual transaction costs that are involved that the insurance company wants you to pay for. In addition to that, there is a grace period, which is usually like anywhere from 30 to 60 days, where after the payment is due, there's a period of time that it's like a grace period to where they can make that premium payment before the policy lapses. So say like the payment's due and they don't on the 1st of the month, and the 15th of the month comes and they die and they haven't paid that premium yet. Well, the policy doesn't lapse the day that the premium is missed. Usually there's like a 30 to 60 day grace period where the client has that time to pay the premium. And obviously if they die in the grace period, then what happens is that premium is just taken out of the death benefit. benefit. Then there's also level and flexible premium. So a level premium is a premium that never changes. And then there's a flexible premium, which the client can increase the premium or decrease the premium at will. So they can decide whether they want to put in more or less. You may see these on the universal life policies. So next we're going to talk about reinstatements. What this means is like the policy's lapsed and you want to put it back in force. In order to reinstate a policy, you have to pay back due premiums plus interest usually, and you have to usually pay off any loans that are outstanding against the cash value or against the death, loans against cash value if there's any outstanding loans. And then you also have to provide evidence of insurability. So you have to show that you're not like screwed up. You're not messed up to the point where you're not going to be insurable. You do have that ability in a life insurance plan to reinstate it if it does lapse. And people can do it, but you can't do it if like your health has changed or anything like that. So you have to show that you're still insurable and you have to pay back any premiums that you missed. So some companies allow for up to 3 years of reinstatement, but you have to pay back premiums for 3 years and show that nothing has changed in your health. You may have to go through underwriting again. The last thing I'm going to talk about is incontestability. So incontestability has to do with essentially the death benefit paying out. So any insured dies after 2 years, then if there are any lies or material misrepresentations in the application, say the insured withheld something or lied about something or didn't even realize that there was something going on with them and there was, if they die after 2 years of the policy being enforced, they have to pay the death benefit anyway. Now, exceptions to that are things related to age, gender, or identity. So if someone lies about their birthday and the insurance company doesn't pick up on it and they're actually older or younger when they die, then the death benefit will usually adjust as such. If they were older than they say they were, the death benefit payout is going to be less, right? Because they were paying a premium that they should have been paying more. And if they were younger than they said they were, then they'd actually probably get more death benefit because they were saying they were older than they actually were. So they were overpaying on the insurance. And then if some people go through gender changes, insurance companies, they don't really care. So they look at gender at birth. So if a man decides he's a woman, then when she dies, the insurance company says you were a male at birth and genetically, so that's how the life insurance company pays out. So there would be an adjustment of death benefit there. And then also if you lied about who you were, right? Like if you said you were this person and you're really not and you die, then they may actually not even pay the claim out at all. However, there's another caveat to this. If the insured dies in the first 2 years of having that policy, then there is a contestability period. It's called contestability period, where the insurance carrier can actually challenge the claim and can contest it. And they can say, well, based on our underwriting, that person wasn't supposed to die this fast. So we're going to go do another check on all their health and everything else, all their records to make sure that they weren't lying about anything. And then we're going to make sure that we can actually insure them. So those are the 3 things I covered in this video. I hope you enjoyed it. I'm going to go over the basics of qualified versus non-qualified plans. So a qualified plan is a employer-sponsored retirement plan that's approved by the IRS. So a qualified plan, it gives the employer and employee benefits like deductible contributions and tax-deferred growth. A qualified plans mean it's been approved by the IRS. Okay, it's qualified by them and the Internal Revenue Service says, yes, this is something that you can run. Qualified plan has certain tax contribution deduction benefits. So what that means, if someone pays in to the plan, then what they pay in is deducted from their taxable income. So I don't have a form here. I wish I could write it out for you guys. Maybe I could on a little notepad here. But think of it like this. So say someone has $100,000 income and then they spend $5,000 on a qualified plan. Okay, that $5,000 can be deducted from their income. And now what do they have? $95,000. I don't know if you can see that, but $95,000 becomes their income that they're taxed on. So the tax benefit is that whatever they can contribute to it gets deducted from their taxable income. So now they're paying income tax on $95,000 instead of the $100,000. So that's the basis of it. If you own a company as an insurance agent, you can actually start a company. And this is not tax advice, but this is just some stuff I know. If you own an insurance agency, you create a corporation. What you can actually do is there's special IRAs for corporations that we're going to learn about where you in special qualified plans where you can write off like a ton of money every year to help lower your taxable income. It gives benefits to the employer and the employee, contributions and tax deferred growth. What's tax deferred growth mean? It means you don't get tax on it until later, okay, when you take the money out. Now it's designed to benefit the employees and their beneficiaries. So it's designed to be in benefit of the employees. And it's communicated to every employee when they start somewhere. And it has to be formally written down. It has to be like a packet that someone gets and read. And it can't discriminate in favor of like executives or highly paid employees or anything like that, or stockholders or officers. It has to be in benefit of the employees, okay? And it's got to be a permanent plan. They can't just get rid of it. It has to be approved by the IRS, and they have to have certain vesting requirements. Vesting requirement means like you have to be a certain amount of somewhere a certain amount of time before you can take the money out, or certain contributions are certain benefits are available. That's a vesting period where the employer will contribute a certain amount to it. There's a vesting period. And then a non-qualified plan does not need government approval, and you actually contribute after tax money. So say they have that same income situation, you make $100,000, you pay tax on that $100,000, say you end up with $70,000. Then you take some of that $70,000 after tax money, then you pay into it with the after tax money. So it's a little different in that aspect. The pre-tax world of a qualified plan, the money is taken out before. That's why, like, if you've ever contributed to a 401k, or what it would look like on your paycheck, you see the deduction, and then you see your paycheck, you see your gross pay before taxes and then after taxes on the breakdown. So they take out the contribution before your paycheck gets taxed. That's how it works. All right. It's like an annuity, deferred compensation. So deferred compensation is like when they take your money, they pay it to you later, different bonuses, stuff like that. So in summary, a qualified plan has tax deductible contributions. It's approved by the IRS, can't discriminate between different people as long as you're part of that group of employees. And earnings grow tax deferred, actually on both the non-qualified and qualified plans, earnings grow tax deferred. And all withdrawals are taxed on the qualified plan. The qualified plan, you put the money pre-tax, and the tax is deferred to later. And then once you take the money out, then you pay tax on it. Non-qualified plan, then you're taxed in excess of what you paid in, okay? Because you already paid tax on what you paid into it. So say you paid $50,000 into it, and you decide you want to retire, and there's $100,000 in there, and say you took it all out. You'd only be you wouldn't be taxed on the whole $100,000. You'd be taxed on the $50,000 that you didn't pay in on the earnings. If you put in $50,000 of pre-tax money and then you left with of $100,000 total, I mean, you paid tax on that whole thing because you haven't paid tax on any of it yet. Okay. So rebating is essentially like if you rebate a premium for a client and it's not available to everybody. So the definition is like you can't give any discounts on premiums or rebates to premiums when it's something that's not specified in the actual policy itself. All right. So say someone's policy is like $100 a month. You can't say, look, I know it's $100 a month, but I'm going to cover 50 of it for you for the first year. So you can't say like, okay, well, yeah, so it's $100 a month. You pay 50 a month. I'll cover the other 50 a month for the first year of the policy. You can't do that. That's rebating. It's illegal to do anything like that. Rebates are applicable if like everyone has it, if it's like a discount or something like that, but you can't just go individually rebate something yourself. And that has to do with premiums or special services or stocks or bonds, mutual funds, securities, dividends, stuff like that. You can't be like, hey, I'm going to pay you extra dividends this year or like extra benefits. That's not, if it's not in the policy already, then it's not, it counts as rebating. Don't rebate. You could lose your insurance license. So reinsurance is essentially a contract under which one company covers another for its liabilities. I'll give you an example. Say you're in Florida. Imagine you are a property and casualty insurance company in Florida and you are issuing policies for homeowners insurance, right? And we get hurricanes sometimes down here that cause a ton of damage. So imagine if a hurricane hit the entire state at once and like destroyed every house in Florida. That insurance company probably doesn't have the money to pay the claim on every single house. So the insurance company needs to get reinsurance, which is essentially insurance on its liabilities. Okay, so it's like backup. It's like a backup plan. Now for life insurance, it would be, okay, if there's a crazy illness and like a ton of people die or like a war and a bunch of people die, they would need reinsurance usually for that situation. Or if the company just didn't do their actuarial stuff properly, they're being too lenient in their underwriting and more people die than they expected. So this is to make sure that the insurance companies can survive even if there are catastrophic losses. Now, the original company is called the ceding insurer, and the one taking the liability is called the assuming insurer. Now, when reinsurance is on a specific insurance policy, like if I buy a policy and then that one specifically only is reinsured, it's called facultative reinsurance. It's for the reinsurer to take on all the risk. It's called a reinsurance treaty. Now, usually that's in place for a year or longer. So if a company is saying, we're going to take on all the risk in this pool, then that's called an insurance treaty, and usually that's in place for a year or longer.